The committee will come to order. The Oversight Committee mission statement is that we exist to secure two fundamental principles. First, Americans have a right to know the money Washington takes from them is well spent. And second, Americans deserve an efficient, effective government that works for them. Our duty on the Oversight and Government Reform Committee is to protect these rights. Our solemn responsibility is to hold government, I repeat, government, accountable to taxpayers because they have a right to know what they get from their government. Our job is to work tirelessly in partnership with citizen watchdogs to deliver the facts to the American people and genuine reform to the federal bureaucracy. Today's hearing is most important because, in fact, since 2009, Europe has been struggling to emerge from a severe sovereign debt crisis brought about by massive government spending and a weak economy. America could say the same, that we, in fact, have been struggling since 2009 to emerge from a severe sovereign debt crisis and brought about by massive government debt and, in fact, a weak economy. But that's not the issue today. The issue is not America's economy or our sovereign debt. The issue is if the European Union and International Monetary Fund spend hundreds of billions of euros to aid Greece, Ireland, Portugal, the EU, and with IMF assistance, if in fact America will be drawn in to this problem. Can America afford one sovereign debt crisis such as Greece? I believe after over a year of watching the Greece on-again, off-again crisis, there is a certain assumption that eventually it will be solved, a certain assumption that we know what we're doing, a certain assumption that, in fact, it will in time be solved. Clearly, this hearing, which builds on the good work of Chairman Patrick McHenry, is, in fact, to ask a greater question. The greater question is, what if we go beyond Greece? Assumptions are that between hedging and, in fact, other means, that the problem is manageable. Our obligation is to say, what if it's not? Our witnesses today are the two most important individuals at the center of this. Our Fed chairman certainly has a good understanding of our economy, what the Fed's capabilities are, and ultimately what he can do if, in fact, things go wrong. Secretary Geithner, who has been a loyal servant of the American people, both at the Federal Reserve in New York and now in his current position, also has been intimately involved in both the U.S. crisis and in matters in Europe. So today, our primary questions will be, in fact, on what U.S. exposure truly is, what the impact to taxpayers could be. We will try not to look to the past. We will try to look to the future. But let us understand that while we have a budget deficit of more than $1 trillion, while our debt in the United States is 100% of GDP, well, in fact, we are still remembering the good and the very bad of TARP. We're still remembering both of the individuals before us today came and were involved in saying what TARP would be spent for, none of which came to pass. Ultimately, as Secretary Geithner has recently said, he does not plan on needing a bailout. He does not anticipate it. Our obligation on this committee is to anticipate and to plan. Therefore, the questions today for our two esteemed witnesses will be, what is Plan B? I repeat, what is Plan B if what you're managing is not manageable? With that, I'd like to recognize the ranking member for his opening statement.
Thank you very much, Mr. Chairman, for calling this hearing. I want to say to you, Secretary Geithner and Chairman Bernanke, I thank you for your service to our country, and I thank you on behalf of a grateful Congress and a grateful nation. Mr. Chairman, this is a very important issue, addressing the financial crisis in Europe and the lessons that can be learned here at home from it. Since the last hearing we held on this topic in December, European officials have taken decisive action to reestablish financial stability in the Eurozone. And American officials have helped diplomatically through consultation, through our participation in the IMF, and through the central bank support. No one is declaring mission accomplished, but the signs of improvement are impossible to miss. Unfortunately, it appears that some in the majority see the euro crisis as a justification for imposing extreme austerity measures here at home. Yesterday, the House Republicans released a budget proposal to cut $5.3 trillion over the next 10 years, to end Medicare as we know it and shift costs onto seniors and give further tax breaks to corporations. Today, the majority will seek to draw parallels between Greece's financial troubles and those of the United States. At our last meeting, a majority witness called Greece, quote, a wake-up call, end quote, arguing that the United States should shred our nation's safety net and cut taxes to avoid Greece's fate. Don't believe it. While strong medicine is needed, it is the banks that caused the financial crisis who should be taking the hit. What we have learned from Greece is that austerity measures imposed during an economic downturn have very real negative consequences for working people, hard-working people, while they leave economic elites unscathed. Nevertheless, some Republicans believe we should implement similar extreme austerity measures here at home in the form of deep, cross-the-board spending cuts. Secretary Geithner, on past occasions, you warned against such action. For example, you said this, and I quote, "We need to stay intensely focused on strengthening our economy in the short term. We can't cut our way to growth. So severe austerity now would be very damaging," end of quote. But how Republicans have ignored this key point. Different problems require different solutions. In the case of the United States, economists largely agree that the housing bubble and risky investment products created by Wall Street were the chief causes of our economic collapse. As Mark Zandi, chief economist of the Moody's Analytics, stated, housing is ground zero for the economy's problems, high employment, and lost jobs. Although the recent $25 billion settlement with 5 of these banks is commendable, the sad truth is that millions of borrowers will not receive the relief they so desperately need because one important entity refuses to cooperate. The Federal Housing Finance Agency, FHFA, Fannie Mae and Freddie Mac's regulator, will not allow them to participate in the settlement, reportedly because much of the relief will be in the form of principal reductions. If we want to ensure that our economy at home is strong enough to weather the euro crisis or turbulence from slowdowns in other foreign economies, we must end the housing crisis here at home. We must have principal reduction as one tool for borrowers who are underwater and who owe more than their homes are worth, in many cases through no fault of their own, by the way. FHFA's own data shows that principal reductions would save taxpayers billions of dollars. But Edward DeMarco, the agency's acting director, maintains what happens to be an ideological opposition. It is my hope, as we examine the euro crisis, we keep in mind what should be our ultimate goal: rebuilding and protecting a strong economy for the millions of middle-class Americans here in the United States. Mr. Chairman, with that, I ask unanimous consent to enter the March 20th Washington Post article entitled "The Man Blocking America's Recovery" into the record.
I would reserve, how is it germane to today's hearing?
It addresses this issue.
We can include it as extraneous material, but it was really germane to the hearing we had in New York, and would also suggest that it be placed in the record for that hearing.
Thank you very much. Thank you. That's fine.
Very welcome. We now go to the chairman of the subcommittee, Mr. Patrick McHenry, for his opening statement.
Well, thank you, Mr. Chairman, and thank you for calling this hearing today. Nearly 4 years ago, Americans witnessed domestic and global markets deteriorate, resulting in millions of job losses and unprecedented measures by governments and central banks to prop up financial institutions. As the United States economy remains vulnerable in the midst of a very shaky recovery, just across the Atlantic, our European friends fight to fend off a second wave of economic and financial turmoil. Their lesson is one for the world as well as the United States. In December, my subcommittee invited officials from the Federal Reserve and the United States Treasury to explain the economic unrest facing Europe and what actions they would consider in reaction to it, and what measures remain at their disposal as events changed day by day. At the time, the Federal Reserve had just authorized foreign currency liquidity swap lines with 5 central banks to buy time for a political solution in Europe and for recapitalization purposes as well. And daily headlines read of liquidity injections to the tune of billions and trillions of euros, swinging stock markets wildly. In December, the ECB held a second auction known as a long-term refinancing operation to provide European banks with over 500 million euros in cheap loans, and a credit event was declared in Greece. The credit event in Greece is one of particular concern to markets around the world. As we look ahead, the European story is far from over. European leaders continue to strengthen the weak framework of the EU to substantiate their rescue efforts, and financial markets become more dependent on continued willingness of the central banks to use their balance sheets to rescue the global economy. Understanding that the economic storm facing Europe influences U.S. markets, I commend Chairman Issa for inviting Chairman Bernanke and Treasury Secretary Geithner here to Congress to address this critical issue. I'm interested to hear how our nation's foremost economic experts and authorities view the Eurozone crisis, the impact it can have on the United States economy, and our pension funds and market participants as well. And with that, I'd like to yield the balance of my time to the former Chairman, Mr. Burton.
I thank the gentleman for yielding. The Chairman said in his opening remarks that he wanted to find out if the United States possibly could be drawn into the Euro crisis. I've been to Europe. I've been all over the place over there, including Brussels, and I'm convinced that we're already drawn in. And so I'd like to find out today how deeply we're drawn in and how severe the problem could be, especially if the euro is devalued. And I want to find out if we're underwriting or bailing out the Europeans, and to what extent. When I was in Brussels, I found out that in addition to us printing money with QE1 and QE2, the European central bank's doing that over there as well. So they're inflating their money supply. And the things I'd like to know are, first of all, when my colleague talked about the money swaps, let me first say, according to the Congressional Research Office, our exposure to Greece, Ireland, Italy, Portugal, Spain, and France and Germany is $641 billion for those, and for France and Germany it's $1.2 trillion. So there is that exposure already. And regarding the currency swaps with the European central banks, including Canada, Switzerland, Japan, and the United Kingdom, we have, as of February 15th, $109 billion is outstanding on those lines. And as I said before, if there's a devaluation of the euro, what does that do to our exposure, and how much is that going to cost the United States? In addition to that, Treasury Secretary Geithner has dismissed reports that we might participate in a special IMF European aid fund, and I'd like to know if that's accurate and if that's going to be true in the future. And the President, the Obama administration, indicated that, or increased our contribution to the IMF, which is currently 17% of the IMF's overall budget. And the IMF has indicated it's going to need another $500 billion. And so what I want to find out is how much exposure are we facing right now, and how much exposure are we likely to have added on to us, and are we going to be underwriting the European financial crisis, and what impact that's going to have on the United States of America. Thank you, Mr. Chairman.
I thank the gentleman. I thank both the subcommittee chairman on TARP and financial services and our former full committee chairman. With that, we go to the ranking member of the Financial Services and TARP subcommittee, Mr. Quigley, for 5 minutes.
Thank you, Mr. Chairman. Today's hearing, as we know, builds on the 2 previous hearings we held before the TARP subcommittee, on which I am honored to be the ranking member. As in December, today's hearing will examine the European debt crisis and what it means for U.S. taxpayers and our economy. As Mr. Douglas Elliott of the Brookings Institute testified in December, in 2010, our exports to the EU totaled $400 billion. We have over $1 trillion of foreign direct investment in the EU. The global market is not what it was 10 years ago, or for that matter, 5 years ago. The complexity of the market is such that there can be no question a healthy European economy is in the best interest of the United States and the American taxpayer. The plain truth is when the earthquake of a financial crisis hits, every nation feels its aftershocks, including here at home. That is why I am encouraged by the work Secretary Geithner and Chairman Bernanke have done to engage the EU. I am also cautiously optimistic by the steps taken by Europe's political and financial leaders since our subcommittee hearing in an effort to add stability to the European financial system. European leaders created a fiscal compact under which 25 nation-states agreed to new rules aimed at controlling deficits, and Greece recently restructured its debt. The European Central Bank has also worked to contain the crisis by purchasing bonds and providing loans. These recent actions have lessened the pressure on our financial market here at home. However, it is important to recognize that the Eurozone has a long and challenging road ahead. Countries like Greece, Italy, and others need to implement a balanced approach to their short-term and long-term financial challenges. Some have likened our economy to Greece's, but I believe that the U.S., unlike Greece, controls its own destiny. We need a balanced approach to get our own fiscal house in order. We have to put everything on the table, but we also have to ensure that in reducing the deficit, we don't torpedo our recovery. The truth is that the mission of government matters, but reckless decisions have made it harder to fulfill that mission. We cannot allow politics to get in the way of what is right. We need to take a balanced approach both to spending and revenue-generating measures. The reality is that now is not the time to pull the rug from those who need the help most. But a long-term deficit reduction plan is not incompatible with economic growth. We also must not forget that politics, not economics, nearly saw the U.S. government default on its debt in early August. We cannot allow politics to stand in the way of addressing the home foreclosure crisis, ensuring our nation's seniors have health care, and low-income children have food to eat. As Ranking Member Cummings addressed in his statement, strengthening our economy must be our #1 priority, and we cannot forget about the essential links between our economy and Europe's. I look forward to hearing the testimony from the Secretary and the Chairman on this important issue. Thank you, and I yield back.
I thank the gentleman. Before I introduce the witnesses, I want to caution the committee. It is our policy when we invite guests, and I joked with them both beforehand, to tell them what the committee hearing is about, to expect that they will have answers for our questions, not just answers irrelevant of our questions. But at the same time, they have an expectation that today's hearing is primarily and technically exclusively about the European debt crisis and how it might affect America. So although by definition there's a ripple effect and you may want to ask broader questions, if you ask questions that are not germane to the subject for which we invited our guest, it will be their option of whether to say they were prepared or not prepared to answer them. We want our witnesses to be fully prepared. We only ask them here under that fairly narrow set of circumstances. Now, Mr. Secretary, Mr. Chairman, you're very good beyond that, so I won't be surprised that you may choose to answer questions. But I'm cautioning all of our people that you're our guest. We do not intend to have you ask questions and expected to answer them if they're well outside the scope of today's hearing. With that, pursuant to our committee rules, all witnesses must be sworn. Would you please rise to take the oath? Thank you. Do you solemnly swear, or please raise your right hands, do you solemnly swear or affirm that the testimony you are about to give will be the truth, the whole truth, and nothing but the truth? Let the record reflect all witnesses answered in the affirmative. Please take your seats. A little bit like yesterday with Secretary Chu, We would like you to stay as close to 5 minutes as possible. We'd like you to know that your opening statements, of course, are placed in the record in their entirety, along with extraneous material you may choose to enter after the hearing. And with that, I'm not sure we did a coin toss, but I'll go from left to right. Mr. Secretary, you're recognized for 5 minutes or as you need it.
Thank you, Mr. Chairman and Ranking Member Cummings and members of the committee. Thanks for giving me a chance to come talk to you today about the crisis in Europe and its risks and implications for the United States. This is going on for more than 2 years, of course, but we welcome the attention you're bringing to this important question. Europe is a key strategic and economic partner of this country, and we have an enormous stake in the success of Europe's efforts to avert a catastrophic financial crisis. Our economy is gradually getting stronger, but of course we still face a lot of tough challenges here in the United States. Among those challenges, of course, unemployment is still very high, housing market still very weak. We still have a long way to go to repair the damage caused by our crisis, but we also face a challenging and uncertain global economic environment, with the risks around Iran adding to upward pressure on oil prices and Europe facing a long and difficult crisis. The Euro area accounts for about 18% of global GDP. It's a major source of financing for many emerging economies. It accounts for about 15% of U.S. exports of goods and services, but a larger portion of the exports of many of our trading partners. When growth slows in Europe, it affects growth around the world. And when the fears of a broader European crisis have been most acute, as they were in the summer and fall of 2011 and earlier in the spring and summer of 2010, then financial markets fell around the world, damaging confidence and slowing the momentum of recovery here in the United States and around the world. Now, over the past few months, with our active encouragement and support, Europe's leaders have put in place a more comprehensive strategy to address the crisis. This strategy has the following key elements. First, it involves economic reforms, very tough reforms in the member states to restore fiscal sustainability, to restructure, recapitalize banking systems, to improve the competitiveness and growth prospects of their economies. Second, it includes broader reforms to the institutions of Europe, including the fiscal compact that establishes stronger disciplines on the fiscal policies of the member states to limit future deficits and debt as a share of GDP. It involves a coordinated strategy to recapitalize, as I said, the European financial system with government backstops for funding. And it involves a firewall, a financial firewall of funds to provide financial support to governments that are undertaking reforms so they can help retain access to financing on sustainable terms. Now, these reforms have been aided by a number of actions by the European Central Bank, and together these efforts have helped calm financial tensions somewhat. But Europe is still at the initial stages of what will be a long and difficult path of reform. And for these reforms to work, policymakers in the Euro area are going to have to carefully calibrate the mix of financial support and the pace of consolidation, fiscal consolidation ahead. These reforms, these tough economic reforms, are not going to work without financial support that enables governments to borrow at affordable rates. And if every time economic growth comes in a little weaker than expected, governments are forced to cut spending or raise taxes to compensate for the impact on deficits, this would risk a self-reinforcing negative spiral of growth-killing austerity. The most important unfinished business of this broader financial strategy in Europe is to build a stronger financial firewall. The European leaders are now reviewing options for how to expand the combined financial capacity of their two funds so they can make it clear to markets that they have the resources available on a scale that is commensurate with the needs they might face were the crisis to intensify in the future. As you know, the IMF has played an important role in Europe. IMF has provided advice on the design of reforms, a framework for public monitoring of progress, and financial support for programs in Greece, Ireland, and Portugal. That financial support has come alongside a much larger amount of financial support from the European nations themselves, as is appropriate. It is in the interest of the United States that the IMF continues its efforts in Europe, but the IMF's resources cannot substitute for a strong and credible European firewall. The IMF has played a major role in every major post-war financial crisis while consistently returning to the United States any resources with interest that it is temporarily drawn upon. Our commitments to the IMF are backed by very strong financial safeguards, and in more than 60 years of experience dealing with financial crises, we have never lost a penny. Over the past 18 months, the crisis in Europe has taken some of the wind out of our recovery. We are encouraged by the progress that our European colleagues have been making. We hope they are able to build on these efforts in the coming weeks to put in place a more durable foundation for economic growth and a stronger financial firewall. We do not want to see Europe weakened by a protracted crisis, and so we are going to continue to work very closely with them and with the IMF to encourage further progress. Thank you.
Thank you, Mr. Secretary. Chairman Bernanke.
Thank you, Chairman Issa and Ranking Member Cummings, for inviting me. As you know, for about 2 years, developments in Europe have had an important influence on global financial markets and the global economy. High debts, large deficits, and poor growth prospects have led to big increases in sovereign borrowing costs, concerns about fiscal sustainability, first for Greece, but subsequently for other countries as well. And pessimism about countries' fiscal and economic situations has in turn undermined confidence in the strength of European financial institutions. This has had an impact on the U.S. economy. The European Union accounts for about 1/5 of U.S. exports of goods and services, and we have seen those exports underperform. And, of course, Europe also affects the rest of the world. Financial strains have been evident during times when financial conditions in Europe were the most turbulent. We saw a global retreat from riskier assets. In the United States, those pullbacks from risk decreased stock prices, increased the cost of issuing corporate debt, and affected consumer and business confidence. And we've also seen our own financial institutions, thought to have substantial exposures to Europe, see their stock prices fall and their credit spreads widen. We've seen some improvement. Financial stresses in Europe have lessened in recent months, which has helped improve the tone of financial markets around the world, including in the United States. Several actions by European policymakers have contributed. First, the actions by the European Central Bank to undertake 2 longer-term refinancing operations that have helped European banks lock in their funding. The European banks, in turn, have increased their holdings of sovereign debt, which have lowered borrowing costs for some countries. Secondly, Euro area leaders, including the Greek government and private sector holders of Greek debt, have been taking steps to put Greece on a more sustainable fiscal path. With its sovereign debt significantly reduced, the Greek authorities are intensifying their efforts to implement fiscal and structural reforms, and the EU and IMF have pledged a considerable amount of new funds as part of a second assistance package. However, the Greek economy remains in a deep recession. The third positive step has been the approval of a new fiscal compact treaty among the members of the EU. This treaty is an important step towards resolving the fundamental tension inherent in having a monetary union without a fiscal union, and that should help bolster the viability of the euro area economy in the longer run. Although progress has been made, more needs to be done. Secretary Geithner discussed some of these issues. Further strengthening of the European banking system, an expansion of financial backstops or firewalls to guard against contagion in sovereign debt markets, and critically, we need continued efforts to increase economic growth and competitiveness and to reduce external imbalances in the troubled European countries. The Federal Reserve has been following these developments closely, and we've been in frequent contact with key European policymakers. Our focus, of course, is to protect U.S. financial institutions, businesses, and consumers from any adverse developments occurring in Europe. To help calm dollar funding markets and to support the flow of credit to U.S. households and businesses, the Federal Reserve acted in concert with major foreign central banks to enhance the U.S. dollar swap facilities, as has been testified before this committee. Use of our reestablished lines was limited until late last year. However, in late November, we agreed with the ECB and the central banks of Canada, Japan, Switzerland, and the UK to extend the swap lines through February 2013 and to reduce their pricing. The lower cost to the ECB and other foreign central banks has in turn allowed them to reduce the cost of short-term dollar loans that they provide to financial institutions in their jurisdictions. As was noted, the swap line increased considerably and peaked at $109 billion in mid-February. This has had a very beneficial effect on easing dollar funding pressures in European and other foreign banks, which has in turn lowered tension in U.S. money markets. alleviated pressures on foreign banks to reduce their lending in the United States, and has boosted confidence at a time of considerable strain in international financial markets. As market conditions have improved notably, usage of the swap lines has fallen back. It's currently about $65 billion. I would add that the swaps are very safe from the perspective of the Federal Reserve and the U.S. taxpayer. They present no exchange rate or interest rate risk. Each drawing has a short maturity and must be approved individually by the Federal Reserve. They are collateralized by the foreign currencies for which the dollars are swapped, and our counterparties are the foreign central banks, not the commercial banks who are receiving the dollar loans. Fed has also worked with the FSOC and other agencies to monitor our financial institutions. Notably, U.S. financial institutions have very limited direct net credit exposures to the most vulnerable euro area countries, and U.S. money market funds have almost no exposure to those countries. There are some exposures arising from the sale of credit default swaps on sovereign debt, but our assessment is that those are broadly hedged with CDS in the other direction, and that the counterparties to those CDS are broadly dispersed and are strong banks in Europe. Although U.S. banks have limited exposure to peripheral European countries, their exposures to European banks and to the larger core countries is much more material. Moreover, European holdings represent 35% of the assets of prime U.S. money market funds in February, and those funds remain structurally vulnerable despite some constructive steps taken since the recent financial crisis. So the risk of contagion does remain a concern for both those institutions and for supervisors and regulators. In particular, were the situation in Europe to take a severe turn for the worse, the U.S. financial sector likely would have to contend not only with problems stemming from its direct European exposures, but also with an array of broader market movements, including declines in global equity prices, increased credit costs, and reduced availability of funding. Most recently, the Fed released on March 13th the results of our Comprehensive Capital Analysis and Review, or CCAR, which is essentially a stress test of the largest banks or bank holding companies. We imposed a hypothetical stress scenario on these banks that involved a deep recession in the United States with unemployment reaching 13%, a decline in activity abroad combined with sharp decreases in both domestic and global asset prices. This exercise was designed to capture both the direct and indirect exposures and vulnerabilities of U.S. financial institutions to economic and financial stresses that might arise from a severe crisis in Europe. The results show that a significant majority of the largest U.S. banks would continue to meet supervisory expectations for capital adequacy despite large projected losses in an extremely adverse hypothetical scenario. So in conclusion, the recent reduction in financial stress in Europe is welcome, given our important trade linkages. The situation, however, remains difficult, and it's critical that European leaders follow through on their policy commitments to ensure a lasting stabilization. I believe that our European counterparts understand the challenges and risks they face, and they are committed to take the necessary steps to address those issues. And for our part, the Fed will continue to monitor the situation, work with our financial institutions and foreign counterparts to strengthen our financial system, and be ready to use the tools at our disposal to help stabilize U.S. markets should the situation require such action. Thank you.
Thank you. I'll now recognize myself for 5 minutes. Chairman Bernanke, in that stress test, you, I presume, assume that the Fed systems, including the credit default swaps that are backed nation to nation, would work. Is that correct? I mean, you weren't assuming a collapse of all of the, let's say, $1.4 trillion of exposure.
We didn't assume they would work. We checked to make sure we were comfortable with the counterparties.
So, but that means you graded yourself as that part working, correct?
I'm not quite sure what you're asking. We looked at the CDS positions of the banks, and we verified first that they are largely hedged against sovereign default in Europe first, and then secondly, we looked at the counterparties of those credit default swaps and assured ourselves that they are widely dispersed and represent the strongest financial institutions in Europe.
Like AIG did a couple of years ago?
AIG is an example of what we don't see now. AIG was not appropriately regulated. It was not appropriately hedged. It didn't have sufficient capital behind those CDS. We know there's nothing like that kind of situation.
So you're comfortable today that there are no AIGs hiding in the woods, no FP sitting in some small company in London that essentially has bet the bank without us knowing it?
Well, our stress tests have covered all the largest bank holding companies in the U.S. We've looked also at other large banks. with a somewhat less stressful and somewhat different approach. But within that whole range of U.S. financial institutions, we don't see any similar problem.
Thank you. It's one of the most important parts of today is to ask the questions that weren't asked in earlier times before what couldn't happen occurred. Europe has the Eurozone has an economy we'll call nominally our size. It has a debt, if I'm roughly right, of euro conversion of about $14 trillion of sovereign debt. Some countries actually have positives, but we'll just look at their sovereign debt across the board. So it's fair for the American people, not the talented economists, but for the American people to say same size entity, similar debt to ours, not exact, but similar. If that's the case, why is it that they're not being treated, and this is a question for the American taxpayer, if you will, being treated much more like we treat our states? California doesn't look to Greece or Germany for a bailout. They look to the United States federal government. In other words, we're internal. What is the justification for the American people to understand of a zone similar size to ours, similar wealth to ours, similar debt to ours, looking around at the rest of the world and saying, what part will the United States put in to a European Union member such as Greece's problem?
Well, your question highlights the difference between Europe and the United States, which is we have a fiscal union as well as a monetary union. And as you point out correctly, the reason that we don't see the same kind of stresses at the state level is because implicitly there's support, from the federal government for the rest of the country.
Right, but for the taxpayer, and I want to get to Secretary Geithner too, for the taxpayer, heads they are very similar to us in the positive side. Human beings move freely within the Eurozone. Money moves freely. Most of the Eurozone is a single currency, and in fact, they basically act from a winning standpoint as a protective trade partners. They treat each other in a way they do not treat us, period. We simply do not enjoy the advantages of selling into the Eurozone that the Eurozone enjoys throughout the European Union. So the question is, for the American people, and by the way, this is not a question of why are we doing it in our own self-interest. I understand we're doing it in our own self-interest too. But the question is, why is it that the Eurozone isn't being asked by our government to step up much more and take more responsibility? Why is it comes to the American people at all, not why is it in our best interest, but why does it come to the American people when, in fact, they have the same wherewithal, and when they're trading within each other, they trade like states, but when they have a problem with a rogue nation or two or three or four, they turn to the IMF and other external forces for which we participate?
Well, it's a good question. Our position, and perhaps the Secretary can speak to this from the administration's point of view, the position of the United States has generally been that Europe needs to really step up and do a lot more. And we've been encouraging them to strengthen their firewalls, strengthen their fiscal compact, and essentially to move in the same direction as the United States is currently structured.
And, Mr. Secretary, as I go to you, I want to say this because, as you said in your statement, we have never lost a penny to the IMF. We have been fully repaid. Some might say that the interest has not always been what we would hope it to be, but in fact it has been a good bet overall for the world economy. But the American people are wondering what I asked, and I hope you can give it to us in a way. And the follow-up question I'll give you in advance, which is, doesn't it strengthen your hand when we make it clear that the American people are essentially saying no, and you're going to have to convince us, if you need large amounts of money, you're going to have to convince us to go against what is in fact the populist feeling within Mr. Cummings' communities and mine as well?
Well, we have a very similar view to the view you expressed. Europe has Europe's a very rich continent, absolutely has the means to solve this on their own. And you're right to point out that because they're a monetary union without a fiscal union, they don't have the mechanisms we have in the United States, not just to discipline the borrowing behavior of our states, which we have, but we have a set of fiscal transfers which are very powerful in the United States to soften the downturns that individual states might face. The IMF is an institution where members have a right to request assistance, and if they're prepared to meet the conditions the IMF establishes, then they have the right to request that assistance. And our judgment has been that it's been in the interest of the United States and fully consistent with its institution, and certainly better for us as a country, for the IMF to play a modest supplemental role alongside the much more dominant financial role of the European authorities going forward. And where they have asked us for the IMF to take more of the burden, we have said no, we don't think that is appropriate. So we are taking very much, I think, the approach you would take and most Americans would say, which is, they are a rich country. And in fact, nations around the world have taken a similar view, which is that let's make sure people understand for their strategy to work, the world needs to see Europe, that very rich nation, rich continent of Europe, demonstrate that they are prepared to do what it takes to make this work. And we can help with advice and some support on the margin. We are not going to do that in a way that puts the taxpayer, U.S. American taxpayer at risk, and we are not going to do it in a way that shifts the burden of solving their crisis to the American taxpayer.
Thank you. Mr. Cummings.
Thank you very much, Mr. Chairman. Secretary Geithner, Europe has a housing crisis, does it not? Does it?
Parts of Europe do.
And so to restore our economy, you would agree that housing has to be addressed. Do you believe that?
Well,
the foreclosure situation that we are going through right now.
I do think that obviously our economy, as I said, is still suffering from a lot of damage, collateral damage, fallout from our crisis. You see that in housing, not just in high unemployment. And our judgment is that we should do everything we can to help repair that damage, and that would make the economy stronger over time. And that's what we are trying to do.
Now, our House Republicans released a budget proposal this week that would make across-the-board cuts of more than $5 trillion in Medicare as we know it, shift the cost of health care to seniors, slash education, research, and infrastructure funding. And Chairman Bernanke, you and I have talked about this a number of times. You gave a speech back in 2008 in which you said principal reductions that restore some equity for the homeowner may be a relatively more effective means of avoiding delinquency and foreclosure. Is that right?
Our research shows that sometimes it can be effective, yes.
And Secretary Geithner, you also agree that principal reduction can be a critical tool if it's well designed. Is that right?
Yes, in some cases, and that's why you see private investors and private banks on their own, in many cases, offering principal reduction to their borrowers.
Now, how did Europe deal with this, the foreclosure situation?
Well, there's actually a very limited number of countries in Europe with quite that same mix, and they are taking somewhat different approaches. But where they're different, it's different because the nature of the problem is different in those cases. And you can't see a common approach across the continent on the housing front yet. And I think it's fair to say they have not been as aggressive as we were in trying to move early to try to repair the damage in the housing market.
Now, mortgage banks across the country are already doing principal reductions because they help their bottom line. They want to keep people in their homes paying lower mortgages instead of foreclosing and getting nothing at all. This helps the homeowners and shareholders. The only official who does not share this view appears to be Ed DeMarco, the acting director of FHFA. Chairman Bernanke, his opposition is strange because his own data, which he provided to us earlier this year, shows that principal reductions would save the United States taxpayers billions of dollars compared to foreclosures. His data also shows that principal reductions would help the homeowners. So based on his own data and based on the law Congress passed to create FHFA, Mr. DeMarco should be doing principal reductions now, but he has refused. Now, Secretary Geithner, I know that you are in negotiations with Mr. DeMarco, and the Treasury has now offered triple incentives for principal reductions. Can you tell us why Treasury is doing that, and why are these incentives important?
Well, I should point out that under the law, the Treasury and the Administration do not have any authority to compel the FHFA to undertake specific activities. And under the conservatorship mandate, they have to make sure they meet a very tough test, appropriately so, to make sure the things that they are doing are in the interest of reducing losses to the taxpayer, maximizing overall returns to the taxpayer. But there are certain cases where we think there's a pretty strong economic case for principal reduction as part of a strategy to limit the future losses to the GSEs. And so we've been having some discussions with him about how to narrow the differences between us. But he'll have to make these choices. And I think maybe on this question it'd be better for me to come back and talk to you in more detail about it separately. Maybe in a couple of weeks we could give you a better sense of where he's going to come out.
Very well. In his letter to us, he said, so that you'll have this when you talk to him, he said administrative costs could be too high to adjust his IT systems. And then he went on to say and he has made that argument to you, I assume, has he not?
He has, but again, I think he's in the process of looking again at those questions, as are we.
Mm-hmm. And so your response was look further?
Yes. Again, we both have the same basic interest, which is we want to make sure that those institutions are doing things to not just help repair the damage in the housing market, but they're doing so consistent with their obligation established by Congress to make sure they're doing things that would limit the risk of future losses to the taxpayer.
Finally, Secretary Geithner, let me ask about the stakes here. Mr. DeMarco controls all of the loans guaranteed by Fannie Mae and Freddie Mac. How many families could be affected by his decisions? Hundreds of thousands, I would think, or millions potentially?
No, not millions, and it's a little hard to tell. You know, I know it's not part of the popular wisdom, but the GSEs were actually more conservative and more careful in their underwriting standards and the loans they took, and so the broader quality of their loans is actually better than the broader market in this context. But again, our job is to try to make sure that we're doing everything we can to reach as many people as we can, whether we think there's a good, strong case for the country on the merits, not just for the taxpayer.
Thank the gentleman. The gentleman's time has expired. Mr. Secretary, we'll also send you a copy of the field hearing information from Brooklyn, which actually has Fed and other representatives' testimony to that point, so that you're briefed before you come back to the ranking member. With that, we go to the chairman of the full committee, Emeritus, Mr. Burton, for 5 minutes.
Is that what you call me?
Emeritus is a forever term, as is chairman around here.
I got it. I got it.
Please, Mr. Chairman.
According to CRS, the exposure that the United States has in Portugal as of September of last year was $54 billion. Ireland was $111 billion. Italy, $310 billion. Greece, $48 billion. Spain, $244 billion. Germany, $635 billion. And France, $685 billion, for a total of $2.08 trillion. I'm concerned about what happens if the euro starts to devalue and how it's going to affect the United States' ability to collect on these indebtedness that we're having with Europe. My first question is, and I'll combine some of these questions so you'll have more time to answer. We're printing money, have been printing money with QE1 and QE2, and I presume this may be continuing. Is there a mid or long-term cost to loaning money that we printed to Europe, and how much will that be? The Federal Reserve has created this foreign currency swap mechanism, and it has outstanding loans, as I said earlier, as high as $1.2 trillion. I understand you say now it's only $65 billion, but nevertheless, that's a considerable amount of money. And I still like to ask, what happens if you do have some defaulting over there and they can't repay those loans? I know the European Central Bank is printing money right now. That will cause some kind of inflationary pressures as well. What will that do to the indebtedness that we have? The foreign currency swaps takes our money and exchanges it for euros. I presume we're getting the money from the money we're printing, and I'd like to have the answer to that. And it appears as though we're providing dollars that are loaned to or swapped with Europe, and then it's used to buy European central bank bonds that are then lent to commercial banks. I believe that's correct. And if that's the process, it sounds like we're cooking the books to make this all look legitimate. Finally, I've been to a number of these countries, and the unrest is very apparent. Some of our European neighbors have not passed austerity measures. And even when they had passed some of these reforms, you still have an awful lot of dissension in the countries. And they've had changes in those governments. And I think there's still a big question whether or not Greece can survive, and maybe Italy, Spain, Portugal, and so forth. So to what extent are we exposed if this so-called European recovery does not take place? And can you give us the figures, or at least roughly the figures, both directly and indirectly as far as the exposure is concerned? And do your numbers include foreign currency swaps or other assistance from the Federal Reserve or the Treasury? I know that's a lot, but if you could kind of run through that, I'd appreciate it.
May I respond?
Sure.
On the swaps, as you said, the maximum was $109 billion. It's down to $65 because it's been very constructive and it's helped improve the market. It's been beneficial to the United States as well as to Europe. If the euro devalues or depreciates, it has no effect whatsoever on our value of our liability, because we get paid back in dollars. So the European Central Bank takes any foreign exchange risk. If the banks that they lend the money to don't repay, we still get paid back in full, because the ECB also takes all the credit risk. So we're not taking any credit risk. We're not taking any foreign exchange risk. The chances of losing any money in this are very, very low, and the benefits are quite significant. On exposure, you mentioned some numbers. I wasn't clear whose exposure you were talking about, but let me just say briefly that obviously our banking system is exposed to Europe. They are a major trading partner. We have many investments there. But it was exactly what we tried to do in our stress test scenario that we just released the results last week. We considered a very severe scenario that included a sharp new recession in the United States, a sharp decline in activity in Europe, a major financial stress, including 50% drop in stock prices. So all of this is sort of an attempt, at least in part, to measure the impact on our banking system of a new crisis in Europe. And of course, there would be significant losses, but what we found was that all the banks essentially were able to meet a reasonable level of reasonable level of capital, even following the losses associated with such an event. The losses would be large, of course.
Thank you, Mr. Chairman.
Thank the gentleman. The gentleman from Illinois, Mr. Quigley.
Thank you, Mr. Chairman. Gentlemen, I guess the academic question is that balance that I talked about in my opening statement about austerity measures and how they impact recovery. Your view in general on that issue, and how the European plan seems to strike that balance, or how effectively it might do that? Either, both of you, please.
Well, I think the answer to your question depends on which country you're talking about. I mean, there are countries like Greece, Ireland, and Portugal, which are currently under European Union, Eurozone, and IMF support, which have essentially no alternative but to do whatever they can to reduce their fiscal deficits. And they've been trying to do that, although the slowing in growth has made it more difficult. More broadly, there are some countries that have some fiscal space, as it's called, and there they might consider a balanced approach, which leaves some flexibility in the short term to deal with the fact that Europe is slowing, their economy is slowing, at the same time addressing longer-term fiscal issues in a comprehensive long-term plan, which is, for example, they're trying to do through their fiscal compact. So that's analogous to an approach the United States might take, which is a comprehensive plan that has both a short-term and a long-term component to it.
I think the Chairman said exactly right. You have to distinguish the countries that lost the ability to borrow on their own without support from those that still have that capacity. In general, for the countries not still in the acute stage of crisis, you want there to be a medium-term plan to gradually phase in the reductions in deficits that have to come. And you want that to be balanced by, complemented by reforms that are focused on trying to improve the growth performance of the economy, make it easier to start a business, things like that. Very important to get that balance right. And as I said, it takes a bunch of financial support to make sure those reforms have time to work. and you want to make sure they're phased in gradually over time, and you want to avoid the risk that, again, every time growth disappoints, and therefore the short-term effects on the deficit are to increase the deficit, you want to avoid the risk that that has to be matched by immediate cuts in spending or tax cuts or tax increases, because if you do that, the risk is you add to the challenge on growth and it's harder to dig you out of this problem. So that's the balance I think you want to have.
And how did they do? I mean,
how are they doing?
Well, if you want to talk about the countries that are more acute, like Greece and Italy and others, how do they do striking this balance? How optimistic are you that? I mean, the concern is for those, if we are so dependent on their recovery, and perhaps we can learn some lessons there, did they go too far with these countries that are really hurting and stymie the opportunity for recovery?
I don't believe you can say that in Greece and Ireland and Portugal, because, again, once you get to that point, there's really no choice, no alternative available to them except to do this mix of very tough reforms across the board. In the other countries in Europe, they're in a different position. They have a bit more time and space to bring a bit more care and balance to the path. Of course, Greece and Ireland and Portugal are very small economies, even in aggregate, in that context. What hurts the United States is the risk of a longer period of weak economic growth in the major economies in Europe. And that's why it's so important that as they've calmed the financial tensions across Europe, that they're able to shift some of the attention, some of the focus in Europe to broader strategies that would make growth stronger across the continent.
And your overall assessment of their chances for recovery, why are they perhaps less optimistic, or you're less optimistic or more optimistic about where what Europe faces versus the U.S.?
Well, I think the fundamental reality of Europe is that this is going to take a very long time for them to work through. And I think just realistically, looking at the prospects ahead, even if Europe is able to be successful in avoiding a catastrophic financial crisis, and they have the means to do that, even if they're successful in avoiding that, then the risks are that Europe is still growing on average at very weak levels, and that will mean that growth in the United States is weaker than it otherwise would be. And again, this process is a lot of risk in it, very fragile, a lot of political challenges this, as your colleagues have said, and that's why it's so important that they are doing everything they can, not just to restore some financial stability, but help lay a foundation for stronger growth, and it's why we have such a compelling economic interest in trying to work with them to help make that happen.
Thank you. My time has expired.
Thank you, Mr. Quigley. A very good line of questioning. With that, we go to the chairman of the subcommittee from the ranking member of the subcommittee, Mr. McHenry, for 5 minutes.
Thank you, Mr. Chairman. Chairman Bernanke, thank you both, Secretary Geithner, Chairman Bernanke, for your service to our government. You've certainly both served in some challenging times, not just in the last 3 years, but over the longer run as well. Chairman Bernanke, I just want to ask about your legal authority, the Fed's legal authority. So the Fed can purchase sovereign debt of the United States, and has. Does the Fed have legal authority to purchase other countries' sovereign debt?
It does for the purposes of reserve holdings, and we currently hold a small amount, relatively small amount of debt of very high quality. I think it's France, Germany, and Japan. But we are not engaging in purchasing debt of troubled countries.
But that could be considered?
We are not considering it.
Okay.
Congress made clear in earlier discussions, I mean some decades ago when this issue came up, that the purpose of this authority was to maintain foreign exchange reserves. I don't think that it was the intent of Congress that we get involved in sovereign debt issues, and it's not our intent to do so.
Well, beyond that, does the Fed accept as collateral for foreign debt, sovereign debt of foreign countries?
Well, some of the debt we simply own as part of our foreign exchange reserves. In other cases, we have various kinds of short-term repurchase agreements and other kinds of arrangements where we do take collateral for a short period. And again, we are making sure that we have sufficient haircuts and so on to make sure that we're comfortable with the safety of those short-term arrangements.
Okay. Thank you. Secretary Geithner, I've got a few questions about the International Monetary Fund. And within Treasury, you have a designee who serves on the 24-member executive committee of the IMF. In terms of the actions taken with the recent IMF loan to Greece, were you involved in that process? Was that a discussion you were engaged in?
Absolutely. You know, we're the largest shareholder in the IMF, and so we pay a lot of attention to any decision, any meaningful decision the IMF makes in that context. Okay.
Now, you know, looking at that, would is the Treasury? I know you've mentioned this before, but I just want to raise the issue again. Is the Treasury, are you considering additional contributions to the special IMF European Bailout Fund?
No, we're not. Our judgment is that the IMF already has $400 billion of available resources it can use, if necessary, to help support the needs of its members. Europe, of course, has very substantial financial capacity to put behind their strategy to resolve this crisis, and therefore we do not see the case for coming to Congress and asking for more authority in this context.
Okay. Now, is the Treasury considering being involved in the IMF's NAB, the new arrangement to borrow facility?
Well, we are in that already. Congress has authorized us to participate in that. So yes, when the IMF draws on the new arrangements to borrow, which is like a supplemental pool of resources, then yes, like when the IMF draws on its quota resources, we do participate in those drawings. And as I said, we have 60 years of experience with how the IMF acquits itself in that context, and the record supports our judgment that there's very substantial, strong financial safeguards to protect the interests of the U.S. taxpayers in that context.
Under Dodd-Frank, and I know you've been supportive of this, but a number of provisions in there, one in particular dealing with the IMF. When our designee, your designee, and our country's designee to the IMF engages in a decision to the IMF to loan money to a country that has a greater than 100% debt to GDP ratio, they have to present Congress with the understanding of why they made this decision and what the credit risk is. Is that being done?
Absolutely. Of course, there's a rich history, a long history of congressional mandates on the votes we can cast in the institution. That's one of the more recent ones, and we'll meet the test of that provision. And it's a 30-day provision, so we would expect that within the next 3 or 4 weeks in front of Congress, the decision-making there. And the way that provision is structured, as you said, in some circumstances where the existing level of debt in the country is high, there's a higher burden on all of us to make sure that the reforms that come with this assistance give us a reasonable prospect that it's going to be improving the path to sustainability.
Well, we look forward to that report. Thank you.
I thank the gentleman. Just to clarify for the record, if I heard correctly, the IMF doesn't maintain a whole pile of money. They maintain the ability to draw by the members based on an allocation. So for the American people to understand, you're not coming to us for new money, but there will be distributions at times within the current limit that just occur as a result, a trigger, so that they don't sit there with all our money. But the fact is they will be taking our money. Is that correct?
Well, you're exactly right. The way the law of the land is structured, we can't lend money to the IMF without the authorization of the Congress of the United States. Congress authorizes the scale of the financial commitments we can make. And what happens is, as members ask the IMF for resources, if they meet the IMF's conditions then and can draw on those resources, then we provide a part of those resources. But again, the exposure we take is backed by not just a substantial amount of IMF gold, but a set of other financial safeguards so our interests are protected.
I thank the gentleman. The gentleman from Virginia, Mr. Connolly.
Thank you, Mr. Chairman, and welcome to both of our guests this morning. Mr. Geithner, you noted in your testimony that Ireland and Spain actually ran large fiscal surpluses, yet they were victims of financial crisis contagion. You also noted that Spain reduced its structural deficit through austerity measures since the onset of the crisis. Do you believe that there's some lesson in that? I mean, I would have guessed that in order to have this kind of crisis, both Ireland and Spain would actually be deeply in the hole of debt. How did that work?
Well, you're right. I think the popular perception is that the crisis in Europe is overwhelmingly the result of decades of fiscal profligacy, and that's not really quite right. It was certainly true in Greece, where following the advent of European Monetary Union, Greece did substantially expand how much it borrowed, and the government grew as the size of the economy to unsustainable levels.
I'm going to come back to Greece, but
in those other countries, what you saw was a very large rise in private borrowing in the banking system and by the private sector, huge rise in private debt as a share of the economy, and a damaging loss in the relative competitiveness of their businesses relative to Germany in that context. And when the crisis hit and confidence eroded, their fiscal positions did deteriorate dramatically, as always happens in that context. But the fundamental cause of the crisis was not a long period of extreme fiscal profligacy.
One of the, Mr. Bernanke, if you wanted to comment, one of the medicines recommended here, obviously, is draconian fiscal austerity measures. We have a new budget out yesterday that certainly subscribes to that philosophy. Many European countries actually adopted that policy in terms of austerity measures. Did those economies grow faster or slower than the United States since 2009?
Well, the economies of Europe, with the exception of Germany to some extent, have grown significantly slower than the United States over this period of time, partly for the reasons you said. Their crisis was more acute than ours. They're in an earlier stage of adjusting to it. They reacted more tentatively and with less overall force than we did in the United States. And for those reasons and the scale of the challenges they faced beforehand, growth has been weaker in that context. And I think the basic lesson in this context is, yes, you want to be very careful to try to balance the imperatives of restoring fiscal sustainability with the recognition that ultimately both long-term fiscal sustainability, not just the immediate health of your economy, depends on your ability to get the economy growing again.
One of the comparisons that often is cited by some, even here in this body, is that the United States, if it's not careful given its debt posture and its lack of fiscal discipline, is going to look alarmingly like Greece. I personally find the comparison invidious, and upon any examination lacking in any serious comparison, given the fact, and I refer, for example, to Michael Lewis's book on the European crisis, it is shocking what went on in Greece. They didn't have macroeconomic data that was reliable. They actually engaged in outright deception when EU officials came to examine the books. They didn't know how much debt they had. They didn't have any kind of central control over their own economy at all, unlike the United States. But I'd like each of you, if you'd care, to comment on that comparison. Is the United States headed toward going down the road of Greece?
Congressman, it's certainly true that situations are not directly comparable. First, Greece's debt trajectory looks a lot worse than ours or that of other industrial countries. Secondly, the economy is a small, less diversified, less strong economy in general, less competitive, their short-term issues cannot be ameliorated by an independent monetary policy since they're part of the Eurozone. So there's some very important differences. That being said, I think we all understand that there are long-term fiscal sustainability issues in the United States, and what we need to do is find a strategy that will credibly and convincingly put us on a path towards long-term sustainability without doing undue damage to the recovery.
Secretary Geithner. Thank you, Mr. Bernanke.
Yes, no basis for comparisons with Greece. Important for people to recognize that our fiscal position, long-term fiscal position, is actually, we're in a much stronger position than the continent as a whole. And it's partly because our economy will grow faster than Europe's over time. It's partly because we're a younger country. It's partly because the commitments we've made to health care and retirement security, even if unsustainable, are much less generous than is true in Europe as a whole. And those factors and the ones the Chairman mean that we're in a fundamentally different position, a more comfortable position. But of course, in the United States as well, we have made unsustainable commitments. Our deficits are unsustainable over the long run. We have a little bit more time and substantially more room for maneuver in how we address those. And very important, as we address them, and we need to address them, we can't put them off indefinitely, we do so in a way that achieves the necessary balance between helping the economy repair the damage from a terrible crisis, making sure we can invest in things we need to grow, but still restoring us some gravity to our long-term fiscal position.
The gentleman's time has expired. Mr. Gowdy from South Carolina is recognized for 5 minutes.
I thank the gentleman, Mr. Chairman, from North Carolina. Mr. Chairman, is there an interconnectivity between cost of energy and economic recovery?
Yes, there is, particularly when there is a supply-side element, which there appears to be, given some reductions in available supply and tensions in Iran and so on. Higher energy prices create at least short-term inflation pressures, and moreover, they act as a tax on household purchasing power and reduce consumption spending, and that also is a drag on the economy. So yes, higher oil prices, higher energy prices are a concern.
And I think the price per gallon in Europe is about double, if not more, than what it is in the United States.
Yes, because of much higher taxes.
So can you imagine any scenario under which someone would advocate for boosting our price per gallon to European levels?
Well, there are a lot of policy issues related to that.
I mean an economic reason, not environmental, economic.
Well, the question is whether or not there are other goals that are served, environmental goals, congestion goals, and the like.
I'm just asking from an economic standpoint.
From a purely, GDP growth perspective, I think, I think higher energy prices would probably slow growth, at least in the short run.
Well, what word would you use to describe it if our price per gallon talismanically doubled?
That would have a
catastrophic?
I wouldn't say catastrophic, but it would have a very, obviously a very negative effect on consumers, consumer confidence, consumer real incomes, at the same time that it would push up inflation.
Thank you. Mr. Secretary, what is our debt as a percentage of GDP currently?
I can give you the precise numbers in writing, but as we measure it, which is—
I'm not going to hold you to a precise number, just something around that a lawyer can understand.
As we measure it, which is debt held by the public, and we try to measure it net of financial assets, which is the appropriate way to do it financially, our debt-to-GDP ratio is somewhere between 60 and 70% of GDP today.
All right. Since I have been here, there has been one request for an increase in the debt ceiling. I understand there's another one coming. I don't know whether it will come before the first Tuesday in November or after the first Tuesday in November. I want you to assume, and again, I'm not going to hold you to the number. You don't need to go research it. You're smart enough. I've seen you testify before enough to know that you probably will be able to answer this question off the top of your head. If this were the last debt ceiling increase you could ask for, the final one, and you had to make it large enough for all current and future obligations, what would the request need to be?
Well, I don't know how to answer that question. Let me answer it slightly differently. It makes no sense for the country. Since Congress controls how much we can borrow every year, we have no independent authority to spend beyond what Congress authorizes. For Congress to put itself and its members through the position every 6 months or every year to hold a separate vote, politically difficult vote, on whether they should continue to authorize us to do things they've already authorized us to do. But I don't know how to answer that question because you're talking about the future. The best way to—
Well, the last debt ceiling increase was for how long and for how much?
Well, under the deal we reached last August, we set up a mechanism, I believe, where Congress imposed on itself 3 votes over a 15-month period.
What will be the amount of the increase in November or December?
Well, it depends. Congress makes this choice, and the Congress has to make the choice based on how much time they want to give them. So,
right, but you've seen the numbers. In fact, I made a note. You used the exact same word that Chairman Ryan uses. And I hope they don't run any ad showing you pushing a senior citizen off a cliff in a wheelchair for using that word. But you just used the word unsustainable.
Right.
So my question to you is, if we had one more chance to borrow all the money that we need, assuming current variables, how big would that number have to be?
I don't know how to answer that. I think that if you, let me try this a little differently. You'll have to decide as a member of Congress how much time you want to give Congress before you have to vote on it again, and you can choose that amount of time. The larger the number you create, the do it. But again, the debt limit doesn't decide how much we can borrow. You decide how much we can borrow, because every year you decide
how much debt would we need to meet current and future obligations, assuming the status quo indefinitely?
Well, that I'd be happy to get you in writing. I can't do it in my head, though.
How about a round number?
No idea. I just can't do it in writing. But if your question is that if Congress authorized no additional increase in spending or revenues forever, how much we have to borrow? I can do that question in math, but I got to
20 trillion?
I just can't do it in my head.
50 trillion?
I don't know.
I've seen you work before. You're smart. You're quick.
I'm not smart enough.
A lot? Can we agree it'd be a lot?
It would be a lot. It would make you uncomfortable.
Right. Thanks. Thank you, Mr. Chairman.
It would make you uncomfortable. Interesting transition. Ms. Holmes-Norton is recognized for 5 minutes.
Thank you, Mr. Chairman. And thank you, Secretary Gettner and Chairman Barnick, for being here. Every country and every culture, of course, is very different, and it's very risky to go looking at cultures, whether it's Greece or some culture or country that you perhaps admire. I do want to ask you about Germany. There are some in the Congress who believe that the way out of our present recession and dilemma is to impose draconian cuts repeatedly, even forsaking the budget deal that was very difficult to reach, was reached at a huge sacrifice, the loss of our AAA rating. I look to Europe. This was a worldwide recession, and look at the difference among the various countries. The British seem to have adopted something of that approach to emphasize retrenchment over growth. I'm intrigued by Germany, everybody's favorite example of the strongest economy in Europe, perhaps the strongest in the world today, and do not understand and believe we need to come to grips with the theory that they have embraced during this recession. They are one of the few countries in Europe not to cut the budget deficit. I take it wasn't terribly out of control, but I don't know. I'm going to ask you. In fact, they've added to their deficit, certainly in 2009 and 2010, one of the few countries in Europe to do so. But I'm truly intrigued by a country that did not abandon its working class, did not abandon its social net, has a national policy that is maintained of keeping unemployment low. I know they have some things that are culturally oriented toward them, like work sharing and the rest. They also, of course, subsidize employers to keep people on the job. We do that in a scattered fashion. But I believe we have to come to grips with why this country continues. It's a country that we identify with so closely. And we need to come to grips with their model and how they do it. So I have to ask you, how has Germany maintained its strength, continued to grow without cutting its budget deficit?
Let me take a first stab at that. Germany has achieved quite a bit. When they had reunification a couple of decades ago, there were significant problems with the competitiveness and efficiency of their industries, trying to integrate the two parts of Germany together and so on. And they made a very sustained and successful effort to increase the competitiveness and efficiency and productivity of their industry, which is all to their credit. In addition, though, as part of the Eurozone, they have benefited quite a bit from that arrangement. First, because they have sort of an export market that they have easy access to, and secondly, because the euro, which is an average of reflects an average of the economic strength of the different parts of the Eurozone, is probably weaker than a Deutschmark would be, which means that they have something of a currency advantage to some extent in their ability to export.
Well, just like we have a currency advantage.
I don't know about that.
Not today, all right.
Yeah. So
certainly
this is more or less permanent, I think.
Oh, go ahead.
As you point out, they did also had work-sharing policies, which in this particular case, it's a question whether that's a good strategy in general, because sometimes it could promote inefficiency because there's not movement of workers between different industries and so on. But
of course, nobody claims that the Germans are inefficient. Go ahead, Mr.
In this particular case, they avoided some of the sharp layoffs we saw in the United States, and their unemployment rate remained lower. In fact, it's lower today than it was before the crisis, and that in turn meant that their fiscal stresses haven't been as great as that in the United States or some other countries. So they've had a number of things supporting their economy, and certainly they deserve credit for their improved competitiveness. But it is the case that not every country in the world can be a major exporter. Somebody has to buy. So that model is not necessarily exportable in itself to every country in Europe.
Gentlelady's time's expired. Mr. Turner from Ohio. Gentlelady's time's expired.
I wanted to hear from Mr. Gettler as well.
Gentleman from Ohio, Mr. Turner is recognized for 5 minutes.
Thank you, Mr. Chairman. Secretary Geithner, the title of this hearing is Europe's Sovereign Debt Crisis, Causes, Consequences for the United States, and Lessons Learned. Focusing on that portion of lessons learned, I have a concern as we look to the issue of Europe that stems from my concern from the bailout process that has gone through in the United States. And largely as we look to what occurred in the U.S. with bailouts, I think many people like me have a significant concern of conflicts of interest, issues of lack of transparency, and a lack of openness. Mr. Secretary, you, as we look to the auto bailouts, you served in 3 different roles. You served as the Secretary of the Treasury, looking at issues of the taxpayers' dollars and exercising the ownership interest by the United States to the extent that the United States became an owner frequently in the auto bailouts. You served as co-chair of the Auto Task Force and board member of the Pension Benefit Guaranty Corporation. You were not merely involved in the GM bailout, but you were simultaneously leading all of the agencies on every side of the deal in one role or another. And throughout these processes, you've refused and Treasury's refused to answer questions. You've provided unredacted documents or disclosed relative information that people have asked to try to hold accountable the Treasury to find out what has occurred, where the tax dollars have gone. And one of those issues obviously affects Delphi salary retirees, where 20,000 people across this country lost a significant portion of their profits as the 3 roles of the Treasury, the co-chair of the Auto Task Force, and the Pension Benefit Guaranty Corporation picked winners and losers, and they were ones that, with our tax dollars, were picked as losers. If you looked at that hardship that was imposed on tens of thousands of Delphi salary retirees left in the wake of the GM bailout, and then you have concern as to, how we look to the European crisis and whether or not similar conflicts of interest, taxpayers' dollars, and a lack of openness or transparency. As you know, as the Delphi salary retirees have tried to get the information as to what happened, how they lost their pensions, the 3 roles of yourself, both in Treasury, PBGC, and the Auto Task Force, have been closed. Documents have not been provided. Redacted documents have been provided, if at all. And most recently, we have the PBGC acknowledging your role as the ultimate authority in the decision to terminate Delphi pensions. With the GM bailout, you were involved in many of the decisions to terminate these. But yet there is this sense of how do we have a system through bailouts where a person like yourself would have the 3 roles that conflicts exist, and yet Congress have no ability for oversight. Individual who lost their pensions, who don't have an ability to hold you or Treasury accountable in seeking additional information. And as you know, this comes at a significant price. We have the $1.3 billion loss on the Chrysler deal, the 25 or so billion that's at risk in the GM bailout. If we look to the European issue, how can we be assured, looking at the performance of what occurred in the prior bailouts, that we're not going to have this issue of conflicts of interest, of lack of transparency, that there will be some openness, that Congress, that people who are impacted by this will have access to information? I sit here as a member of Congress knowing that that Treasury and is not answering the basic questions about the decision-making that occurred with the Delphi salaried retirees losing their pensions, and wondering how then can we look to perhaps a European issue and not know whether or not our own government is going to be willing to tell us the decisions that are being made and the basic financial underpinnings of the decisions that occur. Mr. Secretary?
Good questions. Let me try to be responsive. Our financial crisis caused enormous damage across the country, not just in the case of Delphi, but that's a good example of how much damage caused by the causes that led to this crisis. We have, of course, cooperated very closely with this committee and every other congressional committee in making sure we are as responsive as possible for all your requests for information, and we'll continue to do that.
Oh, Mr. Secretary, does that mean that you'd be willing to release unredacted versions of the documents that, I mean, you say you've tried. If you send us documents that are redacted, or you, in litigation that's pending, send redacted documents, you're not being forthcoming. That's not the, here's what your government did.
Of course, I disagree with you on that, but we'll try to be as forthcoming as we can. But let me just point out, every action we took in this crisis has been subject to not just the oversight of 4 separate independent bodies established by the Congress to oversee our actions, but by all the congressional committees involved. All the actions we took in the auto context were reviewed and validated by the courts, which is a good set of checks and balances in our country.
Well, no, wait a minute, sir. The one with the Delphi retirees is still pending, and you have not been participating.
The Secretary can summarize his answer.
And I just want to point out that we have provided an incredible level of transparency over every decision we made with the taxpayers' money in that context. The roles you described to me are roles Congress gave me and my predecessors. There is no conflict in those roles. And again, we have a very strong, robust set of checks and balances in this country, appropriately so, that gives you the ability and the authority and the right to oversee everything we've done in this context, which I know you'll continue to do. And I respect and honor that process.
Gentleman's time has expired. Ms. Maloney from New York is recognized for 5 minutes.
Thank you, and I'd like to join my colleagues in welcoming Chairman Bernanke and Secretary Geithner. And Secretary Geithner is a former resident of New York, and I think I speak for all New Yorkers when we say we are so proud of you and your service, and thank you, Chairman Bernanke. I'd like to follow up on my good friend's questioning. There is a consensus in this country that if we had not invested, he uses the term bailout, but if we had not invested in the American auto industry, we would have totally lost it. Lost it. I don't know about my colleagues on the other side of the aisle, but it's hard for me to imagine an America that doesn't make its own cars. I would prefer to see more things made in America with American jobs. And it was at a hearing at this committee where GM testified they're now the leading car producer in the world, that they're employing 1.3 million Americans, and that they are now exporting the Volt. I would call that an American success story. I'd call that American dream. If it is true that you are the architect of this program, I'm not so sure that you are. Many people, I'm sure, worked on it. But if it's true that you were the architect of it, we should be carrying him around on our shoulders and thanking him for saving American jobs, building American exports, building up the economy of our country. So I would like to say thank you, Secretary Geithner. Now, I would also like to continue on Mr. Turner's questioning that I think was a really valid one, in that we need to learn. We need to learn from the crises that we just went through. And I'd like to ask both of you what lessons we've learned as a country, and how we're going to be better prepared in the future. Very specifically, how would you compare the actions that were taken by the American government in the face of the crisis that we faced in 2008 and 2009 and the actions we took with the actions that have been taken by Europe? And I'd like to begin with Chairman Bernanke and then Secretary Geithner on what was the difference in the response? What are the lessons that we've learned to make us stronger in preventing it? And I'd just like to close by saying that Christina Romer testified before Congress that the economic shocks of this particular downturn in our economy was 3 times greater than the Great Depression. So because of the lessons and reforms that we put in after the Great Depression, we were better able to combat it. And hopefully the lessons we've learned now will help us not only to combat it, but to prevent it in the future. Chairman Bernanke, and thank you for your service.
Thank you, Congresswoman. We did make a very strong effort to arrest the crisis. It was a global crisis. We worked with the Europeans in order to do that. And I think relative to the history of financial crises, given the size of this one, I think we were pretty successful in stopping it. Since then, I think the United States has been somewhat more aggressive in trying to strengthen our financial system, and I would cite, for example, our 2009 stress tests, which were highly credible and led to substantial capital raises by our banking system. Our capital in our largest banks has increased in the last 2 years by about 75%, something on the order of $300 billion. So we have, I think, taken a lot of positive steps to strengthening our system. There are many aspects of Dodd-Frank, including orderly liquidation and macroprudential oversight, which have been, I think, very constructive. That being said, I think we also have to learn lessons from how we got into the mess in the first place, and there clearly were gaps and weaknesses in our regulatory system, mistakes by supervisors and regulators, including the Federal Reserve. Obviously, lots of problems in business practices, which we're still seeing. And I think we will not have really learned the lesson unless we can correct those issues as well.
Thank you. Mr. Geithner.
I think the best way to look at what we did is to judge us on the results. And if you look at the path of the American economy since the beginning of 2009, you compare that record against the record in Europe and the record in the United States or other countries in past financial crises.
Thank you, Mr. Geithner. My time is almost over. I just would like to put in the record, I've been researching you and getting all your quotes that are very positive about this crisis, that Europe has the ability to avoid the debt crisis, Geithner. And a direct quote was, and he said that the European Union has the ability to avoid a worsening crisis and urged EU members to speak with one voice about plans to solve their debt problems. I have no time left, but yes or no, Chairman Bernanke, do you agree with that statement that Europe has the ability to solve this debt problem?
They certainly have the economic and financial resources. As was pointed out, their economy is about the same size as that of the United States. They face very difficult political problems, getting agreement among 17 countries on a path forward, so it's not going to be easy, but yes, I do think they have the capacity.
Thank you. And Mr. Meehan from Pennsylvania is recognized for 5 minutes.
Thank you, Mr. Chairman. And let me express my appreciation to both of you as public servants for making this commitment that you have at a tremendously challenging time, not just for our nation, but for our world. So I'm grateful for your efforts. And obviously, there are many complexing questions that are part of this overall equation. But Chairman Bernanke, as I was listening to your testimony, one of the things that struck me was in your review of the totality of the circumstances in Europe, one of the places where, in my estimation, you seem to identify a little bit of a hesitancy was with respect to this issue of the currency swaps, in which we take American dollars, make them available to the European banks, as I understand it, and then they're going to be paid back again in American dollars by the central bank. Now, what's the real purpose behind that? And is that any distinction from the other kinds of IMF funding and other things? It's a liquidity issue primarily?
It's a liquidity issue, not a long-term loan. The longest of these loans ever made is 3 months. We have our counterparty is not the country. The counterparty is not the bank. Our counterparty is the central bank, the European Central Bank, which we have every confidence will repay, and we have, as I said, we have the collateral of the currency. So we have a lot of confidence in the financial integrity of those swaps. They have very substantial benefits for the United States. European banks do a lot of their business in dollars for 2 main reasons. One is that they lend in the United States, and so it directly affects their ability to make loans to American businesses and households. Secondly, they do a lot of lending to support trade globally, a lot of which takes place in dollars. And that activity strengthens the role of the dollar as the principal trade currency and as the leading reserve currency. So our interests are very much involved, and at no financial cost, we have achieved a significant improvement in funding conditions in Europe. And as I mentioned earlier, because of that improvement, the demand for those swaps is actually going down. And so we think that's been a successful step. And President Draghi of the ECB has made a point of saying how important the contribution of the swaps was to the stabilization we're seeing.
Is this, you mentioned a 3-month period. Is this more or less a rolling line of credit, so to speak, that over the course of the 3-month period you get repayments and then you make new available credit as well, or access to the monetary?
Yes, but we approve not just the program, but every single draw. So we can, there's never a point where we couldn't end the program.
Well, what's
within
our
a few months.
exposure currently? What's the totality of our exposure?
The totality of our exposure currently is $69 billion, of which $54 billion is to the ECB, and the rest is mostly to Bank of Japan.
Just $64 billion. What's our total exposure in terms of other things by the United States to the European sovereign debt and other forms of?
Okay, that's great.
As our stress tests analyzed, the exposure of our banking system to the debt of the weaker countries is on net about zero, because even though they hold some such debt and they have they've written some insurance on that debt, they have hedges in the other direction that protect them from loss, and we are comfortable in the security of those hedges.
Well, what's the credibility of the hedges? Where does the strength of the hedges come? That
the hedges are written by a variety of stronger European institutions, and we're quite comfortable that we can't imagine a scenario where essentially every major European institution.
Explain to me the qualification, because if I'm not incorrect in your testimony, you did express some reservation that, and it was, there was one area of exposures was currency swaps. I thought I heard that in your testimony.
No, we're quite comfortable with the security of currency swaps.
Okay. Let me ask just one closing question from either of you. We're also living in a very dangerous world, and I know you run these with respect to models. The instability that is currently existing in our relationship with Iran and what may happen. To what extent may these models be impacted by what may be a very problematic future with regard to global unrest? Can this whole system be subject to a complete reordering if we have significant instability in the Middle East?
You mean our banking system?
Yes.
So we haven't done directly stress tests based on a shock to oil prices, but we have done stress tests based on a much more severe U.S. recession, 13% unemployment, and a 50% drop in stock prices. So I think a geopolitical event that caused oil prices to double, as I think Mr. Gowdy perhaps was suggesting, would have effects of that sort, and we believe our banking system has sufficient capital to deal with that. Of course, it would be very costly to the American economy and to the banks and to the financial system more generally.
Okay. Thank you, Mr. Chairman. My time has expired.
The gentleman yields back. The gentleman from Pennsylvania, Mr. Kelly.
Thank you, Chairman. I'd like to yield my time back to the Chair.
Thank you. I'll use it briefly. This has been very instructive. Before we go to a second round, originally we said we'd get you out of here before 1. If we get you out of here before 12, are you willing to stay for a second round? Good. But before we go to that, a couple of quick questions. The European, I just want to clarify, I guess, the European Central Bank can print an unlimited amount of euros. Is that correct? The same as we can print, theoretically, an unlimited amount of dollars?
Yes, but it has an inflation objective, which it's very scrupulous about.
And we know they have only cheated on that a few hundred times. Is that right, Mr. Chairman?
They've had a good record of keeping inflation around 2%.
But they have cheated on a lot of other monetary things. The fact is that Greece is where it is because nobody was watching what Greece was doing while Greece was pumping up its debt. Is that pretty much true?
Well, I would argue that was basically both Greece and some of the other authorities, rather than the ECB, that was responsible for that.
But isn't the European Central Bank somewhat our fair arbiter of whether or not they're obeying it? Who's responsible to prevent within the Eurozone violations by the Eurozone? Because ultimately the value of the debt affects the value because it's on a common currency. They're agreeing to live within certain guidelines, which clearly nobody was watching when many countries just ignored the guidelines, at least as to debt.
Right. There was a Stability and Growth Pact, which in principle was supposed to limit debt and deficit, and it was violated, and for political reasons there wasn't sufficient enforcement of that. They've tried to strengthen that now with the fiscal compact that they've agreed to more recently.
Well, going back to my original question then, within the obligation we have for currency swaps, are they obligated, notwithstanding political pressure, to make us whole? In other words, if hypothetically the euro were to drop in half, they would have to give us back twice as many euros to get dollars. Is that within their jurisdiction, or would they have to go back to that kind of interesting vote of so many members?
No, that's entirely within the jurisdiction of the ECB, and I have no doubt whatsoever they would honor their obligation.
So that's the underpinning of your confidence that these swaps are, in fact, extremely safe.
Yes, sir.
And I appreciate that, because I think the American people have to understand that the swaps that we're talking with today are not the swaps we were talking about in the AIG era. One more question that I know the answer to, but I want to make sure the American people hear. Secretary Geithner, I think the ranking member addressed it toward you. He talked about the huge amount of debt built up in this country in mortgages. And you may have noticed that the word principal reduction comes out of the ranking member in every question. He's very good at it. He's very disciplined. Isn't it true that in Europe, that in fact their loans are recourse, and in the U.S., almost uniquely within the world, ours are non-recourse, meaning in Europe they can't walk away from their loan until they've exhausted all of their resources. In the U.S., you can have a pile of money of millions, and you can walk away from your mortgage if it's upside down and you don't want to deal with it. Is that essentially your understanding?
I'm sure you're right in some countries, but I can't speak to the broader pattern across Europe.
Okay. We found no countries in Europe that were non-recourse. And that doesn't mean that you can't have a loan chosen to be non-recourse, but the ordinary default in Europe apparently is you sign like you would for any personal loan. They take the house and then they come at you for the deficit.
Well, you did see very, very substantial increases in borrowing by households, not just against mortgages, not just for mortgages, but generally in many of those countries in Europe anyway. So even with that slightly different system, you saw in some countries in Europe, very, very large rises in debt by individuals.
Now, I went to the debt clock. Now, that may not be the best one, but Mr. Chairman, it's the one we all tend to use because it's on the Internet. And I looked, and in round numbers, at the time of the crisis, we were at like 14 trillion, about $1 trillion more in mortgage debt than we have today. That shows me that overall debt of mortgages has fallen, if you will, a relatively small amount, certainly less than 10%. What does that really say to you from a standpoint of debt to equity if debt is down by that relatively small amount, but housing values are down less? And how does that make you feel relative to the security of home mortgages? And I realize that's outside the original scope of this hearing. You don't have to respond if you're not prepared.
Well, there's been about $7 trillion of homeowner equity lost by decline in house prices, and so obviously leverage in the housing sector is up. But things are moving in a deleveraging direction as home purchases have gone down and home ownership has gone down, and as there have been write-downs and as people have paid down their debts.
Okay, and I'll now take advantage of this opportunity, wait a second, to call on one last first-round member, the gentleman from Texas, Mr. Farenthold.
And actually, Mr. Chairman, I'd like to yield my time to Mr. McHenry.
The gentleman is recognized.
I thank my colleague for yielding. Chairman Bernanke, Is our current fiscal trajectory sustainable?
In the United States?
In the United States.
No, it's not.
What is a sustainable debt load for a country such as ours?
Well, there's no exact number. I think that the current levels would be sustainable if they were kept more or less constant relative to the GDP. I mean, I think that's an important criterion. If we could, over a period of years, get the debt to GDP ratio to some level like 75%, and then over time even begin to improve that, I think that would be a much better situation. But as it stands, the CBO projections show that on current law, the debt to GDP ratio begins to explode in the next couple of decades.
So explain what happens. You've mentioned this before, and just to clarify, what happens at the end of this year in terms of our fiscal situation?
Well, for a number of reasons. If on current law, if no further action is taken, there will be what I've termed a fiscal cliff on January 1st of 2013 as a number of tax and other provisions expire, including the Bush tax cuts, the payroll tax, UI benefits, and at the same time on the spending side is the sequestration arising from the failure of the supercommittee to agree kicks in. And if all those things happen, I think that would be a very sharp and rapid fiscal contraction that would be a serious negative for the recovery. I hope that Congress will take the opportunity to think through where they want fiscal policy to go, and this will be in some sense a forcing event.
So austerity too fast, and spending cuts too soon, and tax increases that would have a negative impact on economic growth. That's the fiscal cliff you're speaking of.
A very sharp change in fiscal stance in a short period of time would have a negative effect on growth, yes. Again, it is important to achieve sustainability over a longer period, but one day is kind of a short period to have such a big change in the position.
Secretary Geithner, I know you've spoken of this. You're obviously the economic spokesman for the administration, and you've taken that role on in a vigorous fashion. I've heard you speak about the tax increases, the component of the President's budget that raises a number of folks' taxes at the end of this year. But can you speak to this cliff? Because under that scenario of sustainability, the President's budget that he submitted to Congress falls short of that. And there is only one fiscal plan that actually puts us on that sustainable path over the long term, over the next decade, over the next 20 years, over the next 30 years. And that is the budget that we passed out of the House last year. The President's budget that he submitted this year it puts us in a very harsh spiral based on the debt to GDP ratio, based on the tax increases, and for not addressing the cost drivers of our budget. I'll give you an opportunity to respond. Obviously,
I have a different view, but let's look at it this way. CBO just did an assessment of the implications of the President's budget on the long-term fiscal path, and they concluded, as did we, that if Congress were to adopt those policies, then we would reduce our deficits over the next 3 to 5 years to a level that makes them sustainable over time. And what that means is they would bring the deficits down as a share of GDP to the level where our debt burden would stop growing as a share of the economy and would start to fall. That's for the next 10 years.
And that's done through a number of increases in the revenue to government as a percentage of the economy above the historical norm.
I'll explain the mix. If you go back to where we were last summer, before the agreement last summer, we needed to find savings of roughly $4 trillion over 10 years to achieve that objective, meaning getting the deficits down low enough so that the debt stops growing as a share of the economy starts to decline. So we had to hit a $4 trillion target. The Congress agreed on about $1 trillion of cuts last summer, which we're honored to, obligated to hold to. That leaves us with about $3 trillion left to do. And what we propose to do is about half of that through an increase in the effective tax rates of the top 2% of Americans, very few number of Americans affected by that, and to find a balance of other savings across the government.
Unspecified or specified?
Very specified. We have a very detailed set of savings in Medicare, in Medicaid, in other mandatory like farm subsidies and civil service retirement, things like that, that would provide an additional $1.5 trillion of savings. And so the overall balance we propose is roughly $2.5 of spending cuts for every dollar in revenue increases. And the reason why we propose that is not because no one likes to raise revenues or raise taxes, is because if we don't find that additional tax revenues out of our current system, then we have to find $1.5 trillion in spending cuts in Medicare or low-income programs or education or infrastructure or defense, which we don't think we can justify, or we have to ask somebody else to pay higher taxes, and we don't think that's a fair thing to do for the American people. So that's the proposal we made, and we've got some other differences between us, of course, which is, and those mostly relate to over the longer term, how we bring our commitments in health care to a more sustainable level. And as you know, we have fundamental disagreements on what it's going to take to do that. We've laid out an approach designed to reduce the rate of growth in costs, but still preserve that basic commitment to Medicare to retirees. And you know, we have millions and millions and millions of more Americans retiring in the coming decades, and that's an approach which is very different from the approach you guys embrace in that budget.
I thank the gentleman. I would also mention we'll ask that the record indicate the CBO scoring for Obamacare be put in at the same time to sort of complement the two CBO claims.
That helps us, though.
Not so much. Mr. Burton, would you like to lead off the first round as Chairman Emeritus? The second round as Chairman Emeritus. The gentleman is recognized.
Sure. My colleague, I think Mr. Meehan, asked a while ago about the exposure of the United States and our financial institutions. According to CRS, in U.S. dollars in 2011, September 2011, our total exposure is $2.08 trillion. Can you quantify that? You said you didn't know what I was talking about.
I'm not clear whose exposure you're talking about, the banks or the U.S. economy. I'm not quite sure what it refers to.
Well, since you don't understand it, if I submit this to you, will you check it out and let me know? I mean,
oh, certainly.
Could you answer that for me? I'd really appreciate it. The second thing I'd like to ask is one more time. I'm not a banker. I'm not a financier or a financial expert. But I'd like to ask this question one more time, and that is, if there is a default in Europe by Greece, Italy, Spain, Portugal, some of these other countries, and the European Central Bank has to start printing more euros, which would cause an inflationary problem and devalue their currency, you said a while ago, well, we were not in any trouble because they would pay us back in dollars that are holding. But what if they can't? Now, they're going to have to pay for the dollars that they're going to repay us with currency that's been devalued substantially. How are we going to get our money, number one? And number two, would we refinance that debt?
Well, Congressman, first of all, the ECB has been very clear that they are not going to be financing sovereign debtors, and they have not. And their primary commitment is to the low inflation rate, the 2% inflation rate in the euro. So I don't see any necessity or even likelihood that the ECB would print inflationary amounts of money in order to address a sovereign default.
I know, but it seems like to me Europe is absolutely committed to keeping Greece in the European Union and make sure that nobody's leaving. And if these expenses continue in Greece, and they have these civil disorders, and possibly in Italy and these other countries, the European Central Bank and Germany and other countries are going to have to pay the freight to keep these countries afloat. Now, if they do that, it seems to me that the European Central Bank, and I talked to some of the leaders over there, they said that they would, of course, do like we did with quantitative easing, and they would print whatever currency they needed. Now, if they did that, there would be an inflationary spike, it seems to me, at some point. And if we had to recover our debt, how would they repay us?
Well, first, the European Central Bank itself has capital. It has.
You mean they have U.S. dollars?
Well, I guess their capital is in euros. That's correct.
Okay. Well, how would they repay us then?
Well, I guess they get repaid from the banks they lend to in dollars. That would give them dollars to repay.
Well, many of those banks could go belly up as well. So they would, they're going to have trouble recovering that. So the inflationary problem is a real problem. So how would we get our money back?
Well, again, the European Central Bank is a highly solvent institution. It is committed to low inflation. It is in turn supported by a whole network of central banks of the 17 countries, which have their own.
I understand, but that's not really answering my question.
The kind of scenario you're envisioning where they couldn't pay us back would be absolutely apocalyptic. It would mean a collapse of major governments in Europe. It would mean a collapse
Okay, well, let me follow up with this question then.
Yeah.
Let's say that Greece doesn't defaults and they leave.
It's already defaulted.
Well, no, I understand, but let's say they are forced to leave the European Union because they don't comply with the new demands. And we have a cascading effect into Italy and maybe Portugal and Spain and some of those other countries. In a worst-case scenario, the European Central Bank and the other countries say, okay, we're going to try to keep this from becoming a catastrophe, and they start printing euros. We're obligated, and we're involved to a large degree, according to the figures I have. How would we fare in the United States, and how would we get repaid, and what kind of impact would that have on our country? And I know you used the term apocalyptic. I'd like for you just to explain a little bit more thoroughly.
Well, again, the money we've lent, or first of all, we have the swap that we've made, the collateral, we've taken collateral for it, which is coming down, is backed, first of all, by the European Central Bank, which in turn has behind it 17 national central banks which have gold. They have other kinds of assets. Those central banks in turn are backed by the governments of the Eurozone. So it's an extraordinarily unlikely situation that we would lose any money. Again, it's a 3-month obligation. So it just, you're talking about a situation where national governments are defaulting across the Eurozone.
Well, if I might follow up.
30 seconds for a brief follow-up.
30 seconds. I know some of those governments over there are having political problems, and they're not anxious to pour more of their money and their resources into saving other countries. Germany in particular has had some political problems, and it may be more severe. So when you say these 17 other central banks are going to come across and help keep everything afloat, there's a political problem that's involved in that too. So that's why I ask about a worst-case scenario.
I didn't say
I think it's important that we understand all the problems that we might be facing.
I didn't say they were going to support the individual countries. I said that they would pay the United States back the swap money.
Thank you. We now go to the ranking member, Mr. Cummings, for a second round.
Thank you very much, Mr. Chairman. And the Chairman had mentioned a little bit earlier that I'm very disciplined with regard to this foreclosure issue, and I am, because so many of my neighbors and people across this country are suffering tremendously. And I think it was you, Secretary Geithner, who mentioned the $7 trillion in wealth that has been lost. And that's why I do that. And I also do it because I realize it's going to be kind of difficult to address this recessionary problem that we all want to deal with unless we do that. Several Republicans have likened the fiscal situation of the United States to that of Greece, and Chairman Issa likened it to the U.S. financial situation to the sovereign debt crisis. They argue that the social safety net in this country, as we know it, which provides critical support to the nation's 99%, should be tossed aside. Those Republicans have used the European crisis to justify arguments for draconian austerity in the United States, just as it is now being imposed in Greece. Chairman Bernanke and Secretary Geithner, can the financial situation of the United States be reasonably compared to that in Greece? Just curious.
As I responded earlier on this, I think a direct comparison is not appropriate. Greece has a much higher debt-to-GDP ratio. They have a much weaker and less diversified economy. They're a very small economy, and they don't have an individual central bank, a separate monetary policy, so there are lots of differences. But that being said, I think everyone needs to acknowledge, and I'm sure you do, that in the long run, every country, including the United States, has to have a sustainable fiscal path, and we do need to pay attention to that.
I agree. And so would you agree with that, Secretary Geithner?
Yeah, of course. I think it's a very important point on the contrast. The additional policies we have to agree to in the United States to bring our deficits to a more sustainable level over the medium term are very modest as a share of our economy, completely within our capacity to do, without asking the economy to suffer some undue burden, or without dismantling our safety net, or without abandoning commitments to retirees and Medicare and Social Security. The gap between where we are today, where we're expected to be, and what's sustainable in economic terms is roughly 2.5% of GDP, which is a very small challenge relative to what many countries around the world are starting to face. And the existing level of benefits we give our retirees are very, very modest. No one could call them excessively generous. We ask Americans to bear a much, much larger portion of the risks in retiring or in paying for health care than is true in really most of the other economies in Europe in that context. So I see really no comparison in our situations. We're in a much stronger country, much stronger position, both fiscally and financially, partly because we are much more aggressive in responding to our crisis. And even with all our challenges, and we have many challenges, and fiscal sustainability is one of them, we're in a very strong position as a country to address those challenges.
Now, Greece failed to have a firm understanding of what its deficit actually was. In 2009, Greece reported a deficit of about 7%. Months later, this figure was revised to 12%, and again later to 15%. When Greece's sovereign debt was reported, it had no explanation as to how such a monumental error had taken place. Chairman Bernanke and Secretary Geithner, I cannot imagine the U.S. failing to have a firm grasp of what our debt actually is. Would you agree with that?
Well, our debt obligation is complicated. We have unfunded liabilities with respect to our entitlement programs and so on. But yes, I think I have confidence in our government's accounting system. In Greece, there were obviously questions about whether or not the numbers were being accurately reported, and that clearly made things much worse.
Now, in Greece, any monetary stimulus aimed at mitigating financial stress must be channeled through a third party, the European Central Bank, and be it agreed to by several. It must be agreed to by several other nations in the Eurozone. Is that right?
I'm sorry. Repeat the question.
In other words, the monetary stimulus, in Greece, any monetary stimulus aimed at mitigating financial stress must be channeled through a third party, the European Central Bank, and be agreed to by several nations within that in the Eurozone. Is that correct?
That's correct. There's one central bank for the whole Eurozone, and it makes decisions based on the whole Eurozone, not on the situation in one given country.
I guess that makes their situation a little bit more complicated than ours.
It does.
To remedy anything to do with the deficit and spending and whatever.
The main difference is that both the United States and Europe have a single monetary policy, but in the United States we have a federal government and a national fiscal policy. In Europe they have 17 different national fiscal policies.
Thank you very much, Jim.
Very welcome. The gentleman from Pennsylvania, Mr. Kelly.
Thank you, Chairman. And Mr. Secretary, Mr. Bernanke, thanks so much for being here today. I know you're in a difficult position. I've been in that same spot myself very many times. I'm an automobile dealer and have really gone through some times that were very difficult. My question deals more with prime rate and where prime rate goes. And I think if you go back to 47 until present, it averaged somewhere around 9.5 to about 9.8. Right now we're at 3.25. But I remember, and with not really pleasant memories, in the early 80s where it went to 21.5% for prime rate. Now people tell me, are you out of your mind? That couldn't possibly happen. The reason I remember is because we paid 1% over prime for our floor plan. So borrowing money to buy cars at 22% made it a little bit crazy because that meant that we were paying 2% per month on every car that sat in the lot. So the idea then was not to have too many cars in the lot. And what I worry about is our dollar starts to drop in value. And as we start to pump more money into the equation to raise the levels, what do you see happening in the future? I know that right now at 3.25 it looks awfully attractive, and In fact, we just negotiated a loan to build a new building. But it was the certainty, Mr. Bernanke, thank you, by the way, that the banks came to us. We had about 5 bidding for our business, and we came up with what we thought was a real attractive package. But again, the driver for all of us in small business is the certainty of what the markets are going to be, or as we look into the future, how we plan our purchases, our equipment buys, our employee hires, and everything like that. What do you see happening right now, dollar-wise, our value of a dollar, because it does drive what lenders are going to ask for us to give back? I know for me it became very difficult because the covenants changed every quarter. The fact that we had a single-purpose building, they say, you know what, your collateral is not worth what it was before, so you become a difficult risk for us. So risk is the key that drives everybody, whether it's throughout the whole world. We're looking at great risk in Europe and the contagion of it, because I really look at us as mountain climbers, all attached to the same rope, and as they start coming off the side of the mountain, it's going to pull all of us down. Tell me about prime rate. What do you see happening with prime rate? I know we have some certainty, at least for the very near future. Where's it going to go?
Well, first, of course, the Federal Reserve's policy has been to try to keep interest rates low to stimulate our economy. And in that respect, auto dealers and auto purchasers have obviously benefited from a low cost of funding. In fact, what we're seeing now is that auto purchases are going back close to where they were before the crisis. So that's a very significant improvement. So that's part of the plan, is to try and get the economy growing and get people back to work, and that can only be good for auto sales as well as for the economy in general. With respect to the dollar, there are 2 definitions. One is the value of the dollar in terms of other currencies, which may matter for international competition in autos and so on. But there, the dollar has been pretty stable. There's not been any real trend in the dollar over the last few years. The other measure of the value of the dollar is the inflation rate, and there also, with some exception relating to gas prices, inflation has been low and stable. In particular, we haven't had the problem of high inflation that we saw in the 70s, which led to the 21% interest rates that you were referring to earlier. So I think our policies are achieving support for the economy without damaging the value of the dollar. Going forward, as the economy strengthens over a period of time, don't know exactly how long, obviously interest rates will go up to some extent. The dollar will react to the change in interest rates. It will react to expectations about growth in the United States. But we think that meeting our mandate of maximum employment and price stability is the best way to get a strong dollar in the medium term, and that's what we're trying to do.
And I would agree with you. And when it comes to auto sales, but again, the SAAR in 2009 at 16.5 million units a year, dropping to 9.5 million units a year, just through attrition. Right now, we're seeing people whose cars are no longer operable, so they are coming back into the market. But there's still, I got to tell you, when I'm on the lot or when I'm in the showroom, when I look across the desk at people, it's the uncertainty of where they are going to be 3, 4, and 5 years down the road drives their decision to make a purchase or not to make a purchase. So I got to tell you, the stability of our economic recovery is so critical. I look at energy prices right now, and I'm watching the value of used cars drop almost daily, especially cars that are deemed to be gas guzzlers. As they start to drop off, you can lose 35 or 40% very quickly as the price point goes up, and that's the one thing I fear. I watched it happen before, and we're very quickly reaching that tipping point again at about $4, where all of a sudden the whole world stops and we start to go in a rapid decline. But I do appreciate you being here today. I appreciate what you're trying to do. Mr. Chairman, I yield back.
I thank the gentleman. We now go to the gentlelady from New York for 5 minutes.
I thank the gentleman. I would like to ask unanimous consent to place in the record quotes and articles from Secretary Geithner, the President of the United States, Simon Johnson, a former IMF chief economist, all that say that Europe is working hard to address the problem and has the ability to handle the problem. I think it's an important statement.
Without objection.
Thank you very much. I'd like to come back to the stress tests that came out last week, Chairman Bernanke, and 15 of our largest banks examined have sufficient capital to withstand a crisis, according to this test. And by my calculation, that is roughly 78% of all the banks tested. And I would call this overall positive news, although our banks do need to do more. Would you agree? Yeah.
Yes, there's been a very substantial increase in capital and ability to withstand stress. And I would just
have a specific question that pertains to the European situation. What should we be doing here at home in order to ensure that American banks stay well positioned to manage their exposure to Europe and the European financial situation?
Well, as supervisors, the first thing that we look at is capital, and the capital situation is much improved. And as I said, the stress tests mimic to some extent the effects of a intensification of the European crisis on the United States. Beyond that, though, we are looking more specifically at the exposures they have and how they're managing those exposures. So we talked about the credit default swaps and other kinds of insurance. We're also looking at liquidity and other types of aspects of bank safety. So again, we've come a very long way in the last couple of years, and although a blow-up in Europe would be, let me be clear, would be very costly and create a lot of problems for our banks and for our economy, I think we're much better prepared to meet such a challenge today than we would have been a couple of years ago.
Thank you very much. You testified before the Financial Services Committee, specifically on February 29th. You testified and expressed concern about sharp spending cuts that would take place next year due to the inability of the Super Committee to reach an agreement on a plan. And I'd like to place in the record some of your statements, because there is a debate now before Congress on the stimulus versus austerity. May place that in the record, the Chairman's statements before the Financial Services Committee. You can look at them.
No, I'm assuming this is his opening statement?
No. It was in response to questions. No, it was in his opening statement. Yeah.
Oh, of course, without objection.
Okay. And Secretary Geithner, I'd like to ask you, basically, do you think the U.S. government would have been worse off if instead of passing the stimulus package in 2009, it passed an austerity plan? And would you consider, since we now have before us a blueprint of how we're going to go forward with the proposed budget that Congressman Ryan put out yesterday, and it's the equivalent of a severe, would you call this a severe and damaging austerity plan? His proposed plan cuts even more than the final agreement with the Super Committee. And I want to know if you agree with this statement that was in the New York Times by Paul Krugman when he stated, and I quote, "The truth is that if you want to know who is really trying to turn America into Greece, it's not those urging more stimulus for our still depressed economy. It's the people demanding that we emulate Greek-style austerity, even though we don't face Greek-style borrowing constraints and thereby plunge ourselves into a depression." Would you agree with this statement by Mr. Krugman? And what is your response to those who demand that our nation take austerity measures that have not particularly worked well in other countries?
If the United States had not, in the early part of 2009, put in place $800 billion of tax cuts and emergency spending increases, then our economy would have been dramatically weaker than it has been, and we've been in much worse shape today. The estimates, of course, you know, are, and maybe it's worth recalling that in the last quarter of 2008, the economy was shrinking at an annual rate of 9%. And it was only the actions in the Recovery Act combined with those of the Fed and our plans to stabilize the financial system that we had growth resume really quite quickly. As you know, we have some very fundamental disagreement with the President's opponents on the fiscal side. The Ryan plan, as I understand it, would not just cut spending too deeply and prematurely in the short term, but it would dramatically erode our capacity not just to meet our commitments to retiring seniors in Medicare, but would dramatically erode what is already a very weak safety net and leave us without the ability to fund critical investments in education or innovation, which we think are essential to our ability to grow in the future. So we would not support those policies, do not believe they are in the interest of the United States, and do not believe they would be responsible to adopt at a time where the economy is still healing from a devastating crisis.
Thank you. The gentleman from Vermont, Mr. Wells.
Thank you very much, Mr. Chairman. Thank you, Secretary Geithner and Chairman Bernanke, for your incredible service in a pretty tumultuous time. I want to go back to this question that really is a central issue for Congress. I'll start with you, Mr. Bernanke. We're having a debate, as you know, in Congress about, with the level of the debt, is austerity the policy that we should be pursuing, or should it be investment, putting it in broad terms? And on the investment side, have it be something where in the short term we try to maintain low interest rates and rebuild our economy, but have a long-term plan to make for a sustainable fiscal future. On this question of austerity, the budget that's recently been introduced, I think, has implicit in it two assumptions. One is austerity will be beneficial to growth, and the budget that's been proposed in the House for our consideration would cut spending across the board in many of the domestic domestic discretionary areas, infrastructure, housing, medical research, education. It would fence off the Pentagon. In fact, the sequester cuts would be avoided. So, number one, the implicit assumption is that austerity is the path in this budget, the path to progress and growth. The second assumption in this budget appears to be that if we reduce taxes on folks who have substantial incomes, that likewise will lead to growth. My question to you is there any evidence that either the assumption about cutting taxes on high incomes in these economic circumstances does lead to growth, number one? Number two, is cutting some expenditures in these items I mentioned, medical research, education, is there evidence to indicate that that will also lead to growth and a lower debt?
Excuse me. I think the right general approach, without talking too much about specific policies, again, is a balanced approach which works to achieve financial stability and fiscal sustainability in the longer term while being respectful of the need to maintain the recovery at the current stage. And I think that's a balanced approach that can be managed. On the other issues, I think it's also important not just to look at the size of the debt or the debt-GDP ratio, but ask ourselves, what is the quality of the fiscal programs being undertaken? On the spending side, if we're making investments, are they a bridge to nowhere, or are they a type of infrastructure investment that will pay a return and improve economic activity and be worth the investment that's being made? On the tax side, is it smart tax policy? Is it broadening the base and lowering rates and achieving a fairer and more efficient tax code? So on both of those things, I think a balanced approach to fiscal sustainability, but also looking at the specific programs with the eye of trying to achieve healthier long-term growth is very important.
Okay, thank you. Secretary Geithner, do you have anything to add on that? This is the central debate in the House, certainly.
The fundamental debate we have to face and the things that happen at the end of this year require Congress to confront these things, provide a huge incentive to deal with them now. And the choices are, how fast should we cut our deficit? Be careful not to do it in a way that would undermine the economy in the short run and the long run. What mix of cuts and tax increases is most appropriate for the long run? What should be the role of government in helping support investments in infrastructure, education, that have high returns over time? And what commitments should we leave in place to our retiring seniors in health care and Social Security? Those are the things which separate us fundamentally. You know our approach, which is a balanced approach which phases in savings over time as we recover and preserves room to make investments in education and infrastructure so that we're growing over the long run, and maintains a commitment made by Republicans and Democrats for decades in this country to guarantee our seniors a retirement security and health care security in their retirements, and those are things we can afford to do. Now, we can't put off these fiscal challenges indefinitely. Our fiscal position is unsustainable over the long run, but that is not an argument to go and dramatically erode the capacity of this country to make the economy stronger, provide more opportunity over the longer run.
Thank you. I'll now recognize myself for a second round, and I'll try to be brief and keep our promise to get you out of here before 12. Chairman Bernanke, you alluded to how much of the budget, how much of our deficit, or sorry, I apologize, how much of our debt is not really on budget. If you take our on-budget debt, our intergovernment debt, and our off-budget liabilities, contingent liabilities, as a percentage of GDP, roughly, what is our debt?
I'd have to get back to you. I think the biggest component of off-balance sheet is the unfunded Medicare liabilities, 75 years, which is a tremendous number, in the more than 30 trillion, something like that. According to the Medicare trustees, that assumes essentially continuation of the increased costs we see in health care delivery out into the indefinite future.
So at 100% of GDP on budget, we could be at 300 or 400% of GDP, including what's off budget.
As I said, if we don't make any changes to our current fiscal trajectory, it's definitely not sustainable.
Well, Secretary Geithner, and I'm only entering this subject because he brought it up, talked about these costs being small. But isn't it true that America already spends a bigger percentage of GDP than our European allies do on health care? In other words, we already are more generous in health care in the sense of what we spend, maybe not what we get for our money. The Secretary is absolutely right. More than half of all health care is paid for outside of government. But it doesn't mean that what's paid for in government isn't already larger than what Canada pays in government for total health care. Isn't that right?
Not sure about the government comparison, but it is true that the United States spends more total on health care as a share of GDP than other industrial countries.
Well, I'd like to go on to, looking at that for a couple of reasons. There's been a lot of discussion about austerity, and this brings it back home a little bit. I'm an Art Laffer economic model guy. I'm not a Keynesian, clearly. But I think we can all understand, I knew that was good for a laugh, Peter. We can all understand that all economists tend to believe that there's probably a sweet spot, in other words, a right balance of public and private spending, a right balance and so on. As we talk about austerity in Greece or in Portugal or in any country, and we talk about austerity here, and particularly, Mr. Secretary, aren't we agreeing that we're trying to get to the same position, whatever that sweet spot is of promoting growth through not taking it all to the government, and that we're only debating, when you talk about the rate of austerity, we're not debating where we need to get to. Where we need to get to so that the private sector can flourish is probably very similar to where we're telling the countries of Europe to get to, so that the difference of what the austerity we ask for others and the austerity we need to get to may be about how much time we have to get there more than it is about what we need to achieve. Isn't that true?
That's probably right. The fundamental reality, the fundamental constraint we all have to live with, whether you're European or American or Japanese, is you have to get the deficit down to a point where the debt stops growing as the share of the economy starts to decline, and you have to stabilize at a level that's acceptable.
Right. And I want to follow up with that just for the record.
The difference is, just on your first question, is it's partly a debate about how fast and what's appropriate, but it's also a debate about the composition. And the composition, if you look at what divides the country now,
the left and the right will never agree on where government should spend / invest. So we'll assume that part is probably very, very much ours. Chairman Bernanke, you'd already, I think, provided a little bit of a mea culpa, and I'm not going to ask for it again. But you put out a white paper related to the housing and what banks and so on should do. And if you don't mind, I'd like to follow up to a great extent in support of the ranking member. In your white paper, and again, your representative from Richmond, Virginia, and others may have chastised over this, but since it's out there in the record, one of the things that was in the white paper had to do with the possibility that banks should essentially flip their properties into rentals, that was an element. And the ranking member, very disciplined, talked about principal reduction. When we're looking at what is best for people who find themselves in homes that they could not originally afford, I mean, principal reduction in these low-interest times assumes that they can no longer or could not, when they bought the home, afford what they bought. When we look at the potpourri of options, both for the Freddie and Fannie and FHA and for the banks in their roles, would you comment further for this committee, on the record, to try to understand why these alternatives of perhaps you can't afford the rent for this home for a period of time, perhaps that's the best transition, perhaps it's best for the community. I think that's an element that has not been discussed, if you will, by the left or the right, and you did put it in your paper, and to the extent that it exists, I'd like to have it fully vetted.
The theme was that we need to attack the housing issue at different points. Obviously, if we can avoid unnecessary and uneconomic foreclosures, we should do that, and there are multiple ways of doing that. We didn't come down in favor of any specific approach. I think it depends on the situation. But what we noted was that no matter how hard we work, and the country's been working pretty hard on this issue, that there are going to be still a number of foreclosures that occur. People who lose their homes or leave their homes, investors who abandon their properties. And it's bad for the housing market, it's bad for neighborhoods, for empty houses to stand, in a row on a street. So we still think that we should be looking at ways to avoid unnecessary and uneconomic foreclosures. But another part of the problem is the fact that we've got so many empty houses, overhanging supply in the housing market, which pushes down prices and reduces construction. There are various possible approaches to that. One of them is REO to rental, which we described and talked about in our paper. There are other things for houses that are in bad condition. Land banks can purchase them and perhaps bulldoze them if necessary. So our point is only that loan modifications have a role to play, but there's a whole number of different things that can be helpful in the housing market.
Okay, and I'll give the ranking member some additional time if you'd like it, but I want to follow up with one more. And this is much more broadly in your purview, both of you. A number of cities, even states, have found ways to extend dramatically the amount of time it takes to foreclose on somebody that isn't paying. In Brooklyn, where we were, they basically got it out to 3 years if your papers are all in order between the time someone stops paying and perhaps stops maintaining the home and the time that the institution can take possession. In the case of Illinois, I'm sorry, the gentleman is not here right now, they've tried to have Freddie and Fannie, during the foreclosure process, which is being elongated, maintain the home on behalf of the homeowner who's not maintaining it on behalf of the community. I don't want to presume your answer, but would you say that these are probably not helpful to either the long-term credit market or because of certainty, or to the process that we're trying to get beyond and get to where we have a positive market and positive neighborhoods? And feel free to answer as you think is appropriate.
Well, I think delay for the sake of delay is not constructive. The homes deteriorate. The process drags on, and the healing of the housing market drags on. That being said, obviously we've seen a lot of cases where servicers have not performed their due diligence, where they have foreclosed inappropriately, et cetera, and where there are situations where there are questions about the integrity of the process, then we have to take the time necessary to make sure that things are being done correctly.
Yes, Mr. Secretary.
I think the Chairman said it right. There are, of course, huge numbers of innocent victims in this crisis, and there are lots of people who can afford to stay in their homes, and you want to make sure you give them a chance to do it. And there are some people that have already left their homes or need to pursue a more affordable option, and we should help make that easy for them to do it. And you want to make sure that when you foreclose, that process has complete integrity. And so you want to have some checks and balances on that. But I agree with you that the process is taking too long in many parts of the country, and if that could be sped up without compromising those other fundamental objectives, that would probably be better for those communities.
Thank you. Mr. Cummings, a couple of minutes.
Thank you very much. I want to just go back to just a matter that the chairman brought up on Monday in Brooklyn at a hearing, and just get your opinion on this. We had major banks there, and we asked the question about how, when interest rates are lower, and let's say somebody has a mortgage at 6% now, and they are, say, underwater. We were asking, he was asking the banks, what's the negative side, and you can correct me if I'm wrong, Mr. Chairman, of trying to make sure that those people are able to take advantage of lower interest rates. I mean, do you all see that as one of the, you talked about a number of remedies. In other words, did you understand my question? I just wanted your opinion on that. It seems like a lot of people would fall into that category.
No, exactly right. And that's why it's so important that you give people the opportunity to refinance to take advantage of lower rates. And one of the most important things that we have done and what the head of the FHFA has done over the last 6 months is to put in place a much better designed program to help people who are significantly underwater take advantage of lower interest rates. But we want that to happen on a much larger scale. That program is actually getting quite a lot of traction now. You're seeing as you may have heard in New York, a very substantial increase in refinancing by people who are significantly underwater, and we think we're at the early stage of that increase, expect much more to happen. Now, those programs now only apply to the loans that have been guaranteed by Fannie and Freddie, and so we've also suggested that Congress consider authorizing the FHA to provide an additional program in that context, too, just to be fair. Most people, they're not sure who guaranteed their loan, and we want to make sure those opportunities are available to everybody who owns a house.
Just last question. One of the things that I looked at was this whole idea of when the banks did their settlement, FHFA did not bring them under those provisions for writing. As a matter of fact, they didn't. They said we don't want to be a part of that. And I know that you're talking to Mr. DeMarco. Was that a concern of yours, particularly when we've tripled the incentives for those kinds of things? I'm just curious.
Well, as I said, there's a very strong economic case in some circumstances, and that's why you're seeing private investors do it, to reduce principal for people who are deeply underwater but can afford to stay in their home, meet a reasonable payment. And that case will be equally compelling in parts of the people whose loans were guaranteed by Fannie and Freddie. And so what we're trying to do is encourage Mr. DeMarco, who is fully independent and has
I understand that.
To take another look at the evidence, because we think there's a place for doing more in a way that's completely consistent with the mandate that Congress gave him appropriately to make sure he's protecting the interests of the taxpayer as he helps the housing market. So we're working through those numbers with him, and I expect to hear some more from him in the next couple of weeks.
Well, on the behalf of the the millions of Americans who are dealing with this issue, I would ask you to use your most convincing voice to try to get him to move off the dime. Thank you very much, Mr. Chairman.
Thank you. I want to thank our witnesses. We did get you out pretty close to the 12 o'clock. You extended your willingness to answer far beyond the initial scope. I would only ask one more item. Please, the next time we invite you back, remember that this was a committee that has worked a lot in areas that overlap, and accept our invitation as you so graciously did this time. And with that, we're adjourned.